Welcome to the European Market Open, everyone. A minute to go until the start of cash equity trading. I'm Francine Lacqua here in London, and here are your top stories. The RBA surprises with a 25 basis point hike and says more tightening may be needed. The Aussie dollar jumps. European stocks are set to open lower. Apple unveils its much-anticipated mixed reality headset, but will the eye-watering price tag compute with consumers and investors? Plus, the SEC sues Binance, and the chief executive CZ for allegedly breaking securities rules. A crypto exchange calls the complaint disappointing and misjudged. So happy Tuesday, everyone. Let's look at the futures. A lot going on today. I know we'll spend a good amount of time with our Valerie Teitel, also looking at RBA and the impact that's had on Aussie dollar. A little bit of pressure across the board when you look at the European stocks. 50 futures down 0.4%. The dollar weakening, for example, against all of its group of 10 peers. The yield on the 10-year Treasury, little change for a second day. Now, the focus, of course, is on inflation. The focus is also on oil, yet again declining after we heard from Saudi Arabia over the weekend. Traders trying to weigh the outlook for supply and demand following that pledge for extra supply cuts. So you look at commodities and then equity indices, I think just stabilizing. Now the FTSE's just opening down 0.1%, and then we also look at some of foreign exchange, including not only Chinese renminbi, but of course what's happening with Aussie dollar. Look, this is one of the bigger ones. Aussie gained as much as 1%. And the policy-sensitive 3-year government note yield was around actually 6 basis points higher after RBA hiked its benchmark rate by 25 basis points to 4.1%. Frankly, just taking most market participants by surprise. S&P futures, you can see, practically unchanged. And then crude oil, this was a big surprise over the weekend. I know our Manus Cranny also really brought it to life in saying, look, this was a unilateral decision. Does it put extra pressure on OPEC and especially in Saudi Arabia going forward to keep this going? Brent crude 75.92. So one of our top news stories, the RBA surprising markets by raising its cash rate 25 basis points to 4.1%, the highest since April 2012. Now, economists expected the bank to hold steady in light of slowing economic growth. Now, for more, let's bring in Bloomberg's Valerie Teitel. So, Valerie, good morning. Another surprise hike, and of course, you can see the read across against other markets across the world.
Exactly. The second surprise hike in a row from the RBA, and that came after they paused rates back in April. It's around the same kind of issues where they saw signs, first signs of slowing economic growth. They paused rates in April and were left chasing their tail the next two rate meetings, having to hike unexpectedly because inflation, especially those more sticky components of inflation, just isn't falling fast enough for them. And not only did they hike, but they gave some forward guidance that more hikes might be needed. That brings their cash rate up to 4.1%. We've had a lot of sell-side notes recently calling for a terminal rate as high as 4.6. A few weeks ago, that would have sounded crazy. Not a lot had been priced in terms of more hikes from the RBA, but now we got a hot CPI print last week. They raised their minimum wage by nearly 6%, and house prices started to climb again. All of this leading some expectations that the RBA might be a bit behind, and we could have maybe not one, but two more hikes left in the cards for the RBA.
Yeah, and that, of course, could have a read across other central banks across the world. Valerie, thank you so much. Valerie Teitel there with the very latest on the RBA. Joining us now, Skylar Montgomery Koning, TS Lombard Senior Global Macro Strategist. Skylar, so much focus on the RBA, not only because now a lot of banks and economists are saying, look, they should fully price in more from the RBA, but what that means from the Fed, what that means for the ECB in terms of sticky inflation.
Yeah, sure. I mean, the June meeting for the Fed, we expect them to pause. I think the market is toying with whether there'll be another hike, whether that hike would be at the June or the July meeting. And I think the narrative right now is that June meeting is potentially a skipped meeting. And I don't think it's hard to make that leap with data coming in. It's very mixed and it's distorted. So it makes sense to pause and reevaluate. But I think the larger points for markets is that, we're at the end of the tightening cycle for the Fed. Whether we get one more hike or no hike, we aren't at the start of 2022. It's a very different environment. We don't have 500 basis points of hikes ahead of us. And I think the key is that inflation peaked in the summer and it's been declining since then. Inflation surprises, importantly, have been negative for 3 months in a row now. And we in the Fed also know that this rapid tightening we've seen is starting to break vulnerabilities like what happened with regional banks. And I think the next worry is the liquidity that will come with the TGA rebuild. And I think importantly, inflation falling and the financial turbulence that's given the Fed room to not guide higher. And I think, they're still trying unsuccessfully to convince the markets of this higher for longer narrative throughout 2024. And we agree more with the market that eventually the Fed will be forced to cut and cut aggressively in line with history. Yes, inflation is likely above target at that point, but in the past 10 cutting cycles, the average year-on-year CPI at the time of the first Fed cut was 5.8%. And I think the key here is that when you are on the path to recession, it happens quite quickly.
Yeah, and Scott, I don't want to make too many parallels basically between the RBA and the Fed, but it was interesting to see the RBA, for example, reiterating that household spending remains a major uncertainty, but they did mention that house prices were rising once again. So how different is that from what we're seeing in the US and how that influences the Fed?
Yeah, I mean, I think there is a big distinction between how interest rates feed into Australia versus the US, as well as the impact either central bank has on financial markets more generally. It's interesting because Australia is actually much more prone to interest rate rises in terms of the housing market's much more vulnerable. There's more short-term mortgage rate. There's more short-term mortgages. So that rate rise has more of an impact earlier. But at the same time, the RBA is concerned with the currency. And so if you have a policy rate that's falling behind the rest of the world and your currency is weakening, that can feed into inflation quite rapidly. And so that's more of a risk for the RBA than it is for the Fed. On the Fed side, there's less of a transition to the market and to the economy through the housing market because more mortgages are long-term, there aren't as many variable rates. And so that transition mechanism isn't as strong, but there's a stronger transition mechanism through financial conditions. So the fact that, we've had this tightening, we're having this policy rate priced in higher for longer, while it's not the whole 2024 that the Fed is anticipating, it does have an impact. And that does feed into consumer expectations stronger in the US than it does elsewhere. I think the other big difference that you see is with the bank lending standards tightening. And so, the U.S. has been on a path where bank lending standards were already tightening, and the SVB crisis just heightened that and made it more quick. And so credit conditions are rapidly becoming worse. And I think that will feed strongly into the economy, and the Fed's more worried about that than maybe other central banks are.
Skylar, I mean, the big story, of course, is also what happened with oil. And I know you have a note saying, look, commodity complacency. Where do we go from here in terms of market growth, but also how much of commodities we're lacking?
Yeah, I mean, so I think the headline for oil is that OPEC has put a floor on the price, but we also aren't going to see a sustained rally. I think what's more likely is kind of this range-bound trading as prices are caught between slowing global growth and demand on one side, and then on the other side, you've got this reduced supply. And I think to get a sustained oil market rally, you usually need positive demand surprises, not supply cuts. And that's not the current environment. The global economy is clearly slowing. We forecast a U.S. recession, not an extremely deep U.S. recession, a mild one, but that still has a large impact on oil prices and commodity prices more generally. And China, the rebound is consumer driven rather than following the historic example of manufacturing boom. And the Chinese renminbi will also falter as we get into the second half of this year. And commodities, of the asset classes are most clearly showing these signs of global growth worries. And I think that's putting a ceiling on prices, especially in oil. But OPEC, puts somewhat of a price floor. And they're trying to put that floor around $70 a barrel. Saudi Arabia in particular is taking the brunt of the cuts. And the reason that Saudi Arabia is able to cut production and is comfortable cutting production, unlike what we've seen in more recent years, is because U.S. shale isn't coming in to fill that gap. So U.S. shale production, it's forecast to grow this year, but not back to very, very high levels. And Saudi Arabia are doing significant production cuts, which in the near term will deter short sellers, and that helps oil prices settle a bit, but it can't really trigger a sustainable rally.
Skylar, thank you so much. Skylar Montgomery there, Koning of TS Lombard, staying with us. Now, we're also just getting some breaking news out of Klaas Knot. He is, of course, the governor of the Nederlandisch Bank, saying that he sees the first signs of policy transmission in the real economy. Remember, we've seen a lot of models and a lot of course, banks trying to figure out what the transmission mechanism to the real economy is from when you start raising interest rates. It could be 12 months, it could be 14 months. I've even read it could be 24 months. He's now saying we're starting to observe the second round effects. This means that inflation could still be high. It'll be really interesting to see exactly what that means. He spoke in the week before the ECB, widely anticipated to raise interest rates further before another projected increase in July. Coming up, we'll have plenty more on the ECB. President Christine Lagarde says inflation pressures remain powerful and borrowing costs will be raised further to tackle them. So we'll have plenty more on that next. And this is Bloomberg. So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Indicators of underlying inflationary pressures remain high, and although some are showing signs of moderation, there is no clear evidence that underlying inflation has peaked.
Well, the European Central Bank President Christine Lagarde, they're cementing expectations for another interest rate hike at next week's meeting. Now, for more, let's bring in Bloomberg's Western Europe economy editor, Zoe Schneeweiss. Zoe, first of all, it's so good to have you here in the studio, but basically we're also expecting another projected increase then in July. And then we hear from Klaas Knot, and he says, I mean, the picture he's painting is not rosy.
Exactly. Klaus Knot, the Dutch central banker, just spoke in Luxembourg, and his main point was we're seeing the second round effect. So inflation, where up until now it was primarily energy inflation that was driving headline inflation, now we're seeing that in wages, we're seeing that in services, and that means that it'll take longer for inflation to actually calm down. Right now, we know that just last week we got the numbers, and inflation slowed down to 6.1%, so that's great. Back in October, it was above 10, so really good numbers. It's going down, but 6%, I mean, in a way, why are we happy? It's 3 times the ECB's target.
So I mean, I hear quite a lot of people saying, look, is it possible, because inflation has gone down by so much so quickly, but as you say, to still 6%, that people think that it will come down as quickly as it came up. But this is not the picture, certainly, that Klaus Knot or Christine Lagarde are painting.
Exactly, and the thing that's worrying here is underlying inflation, and Lagarde said that yesterday in European Parliament, that underlying inflation, that's the one that strips out energy, that strips out food, so those are considered the volatile elements, that underlying inflation gauge is getting strong, is staying very strong. And we're expecting in the third quarter for underlying inflation actually to be stronger than headline inflation. And that just shows that the persistency of strong inflation will stay, and that means the ECB just can't let up.
So, I mean, Klaus Knot is basically, is he talking about almost a nightmare scenario? So you explained it to me, you know, in very simple terms. It's basically inflation is going to be stuck or stay elevated, but growth is coming down, and also there could be a credit crunch in terms of lending.
Credit crunch might be a bit strong. I'm sure the ECB would be very, very worried if we were actually, anyone was actually saying that. It's more that funding conditions are tightening, so lending conditions are tightening. So if you want to build a house, it just will cost you so much more, and so you're more hesitant to do that. And so everything just is slowing down. That's the thing. One of the things, the ECB wants this to slow down a bit because they saw too much here. But overall, this does mean that the ECB will have to be persistent. The main thing right now is, I mean, June and July, those 25 basis point rate hikes are more or less baked in. Everyone expects that. September is the big question, and that will be very, very interesting, especially seeing what the Fed is doing or isn't doing.
Zoe, thank you so much. And of course, it's all about calibration. This is a difficult task for the ECB. Our Bloomberg Western Europe economy editor, Zoe Schneeweiss. Now, a reminder, officials have also raised the borrowing cost at the fastest pace ever in the ECB's history. We're back with Skylar Montgomery, Koning of TS Lombard. Skylar, again, it's about calibration, right? It's about slowing the economy, but not to a point where you know, the real economy and real people suffer too much. How is the ECB doing right now?
Yeah, I mean, the ECB, I think they're still on track to get to a 3.75% terminal rate. And, you know, the market broadly prices that with terminal expected in the fourth quarter this year. And so I think the question really is how long they stay there and how long that squeezes the economy. Europe lags the US, both from an economic and policy perspective this cycle. From the policy perspective, that means there is still room to tighten. From an economic perspective, we saw U.S. inflation peak in the summer, and we are now seeing a definitive peak in European inflation. So May's data not only saw headline improve, but core inflation, the key part, also turned a more positive corner. But the problem is that the backward-looking nature of the ECB is so prevalent, and there's still this very high level of headline and core inflation. So that's kind of given ammunition to the hawks. And I think that, you know, we can get these kind of few 25 basis point hikes to get a higher policy rate. And, you know, it is possible that we get an even higher ECB terminal rate than that. But as they continue tightening, as you say, there's this increased risk that they make a mistake and another vulnerability is exposed. And eventually they'll be forced to stop. I think the key for the market right now is that it'll be later than the Fed, and there's a bit more room until that point. But it is very worrying, this determination, this backward-looking nature of the ECB.
Scott, what does this mean for euro-dollar? If you look actually at currencies, I don't know whether there's a more attractive pairing at the moment or whether euro could take a lot of the brunt of it.
Yeah, I mean, I think it's been a very, very dollar-centric, Fed-focused market. I think, you know, the debt ceiling issues combined with the dialed back Fed expectation, that meant that in the past month, we've seen some dollar strength, especially versus euro dollar. And, you know, I think that upside looks more unsustainable in the medium term. U.S. yields have risen, and the momentum of rates is still against the dollar, though. So despite the fact that we've had this move in U.S. yields, it's not really helping, or the momentum of rates isn't in the dollar's favor. And by that, I mean, when I look at rates momentum, I look at the differential of U.S. rates to say, in this case, European rates. And I look at that differential versus the 200-day moving average, and that tells me the momentum. And given the previous rise in yields we saw in Europe, that momentum is still in favor of euro dollar. I think what's more is that, the Fed is reaching the end of the tightening cycle. As I said, you still have some more from the ECB. And that, tightening ending in the US, it's not reflected in short-term interest rate markets, but it's really not reflected in the FX. The FX has really lagged the move in yields in recent months. I think part of that is struggling with key resistance on these crosses with euro dollar. We've gotten to 110 and we've come back down with 106, kind of preventing a bit of a floor.
Yeah.
But I think eventually we expect the FX to catch up to that rate differential. I will say eventually Europe usually follows the US, but in that interim period, you can get significant euro dollar strength.
Skylar, thank you so much. Skylar Montgomery-Koning, T.S. Lombard, Senior Global Macro Strategist. Thank you. Now let's also get to the Bloomberg Business Flash, and the SEC has accused Binance of engaging in an extensive web of deception and calculated evasion of the law. That's a quote. The U.S. regulator also alleges a crypto exchange misled investors about its trading controls. Now, Binance says it engaged with the SEC in good faith negotiations and will defend the platform vigorously. The list of digital tokens deemed as unregistered securities by the SEC now spans over $115 billion of crypto assets. Bloomberg understands Indian education startup Byju's has elected not to make further payments on a $1.2 billion loan after a dispute with lenders. Now the move escalates a conflict that could jeopardize the future of one of India's highest flying startups. Byju's has been trying to strike a deal with creditors to restructure the loan while also seeking to list its tutoring unit next year. And China's Evergrande property unit has delivered a delayed earnings report that may bring its shares closer to resumption of trading. Well, Evergrande Property Services Group reported a profit of just under $200 million for 2022 that reversed a prior year loss, but fell short of 2020's results. Now, the stock of China's most indebted developer has been suspended for more than a year. And that's your Bloomberg Business Flash. Coming up, we talk about Apple and its new headset. Would you pay over £3,000 for it? Well, we discuss the reaction to the product launch next. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. The top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg.
Welcome back to the Open, everyone. 22 minutes into the European trading day. We're seeing a bit of pressure across the board. But again, if you look at stocks, they're, a lot of them aren't changed. The DAX, for example, is only down 0.1%. A lot of investors really still surprised by, the fact that the RBA raised interest rates above estimates to combat inflation. And so the read across is actually what this means for central banks, maybe major central banks across the world. In terms of the markets that are on the move, look out for oil and, of course, look out for treasuries. And then we have individual stocks that we need to spend a bit of time on. British America's Tobacco new chief executive pledged to meet the Lucky Strike's maker full-year goals despite a weak performance from pretty heated tobacco products and the U.S. cigarette business. You can see British American Tobacco gaining 0.1%. Novo Nordisk actually entering talks to buy Biocorp for about 154 million euros. And then the other third stock we're watching is ASML, the stock down by 1.5%, as of course a lot of news about chip makers and I guess China aimed to counter U.S. efforts at containment and what that means for some of the chip makers in Europe. Now, staying with the tech theme, and Apple has launched its new mixed reality headset with an eye-watering price tag of $3,500. Will people actually pay for a piece of tech that the likes of Meta have already struggled to shift? Well, Alex Schwab from Bloomberg Quick Take joins me now with the very latest. Alex, I mean, it's exciting but expensive. So first of all, who are they targeting?
Not consumers, for now, at least. It was interesting, actually. The first kind of use case demo that they showed in a video was really for the enterprise. It was somebody walking around an architect's studio, that sort of thing. The existing product in the similar space, Microsoft HoloLens, also priced at $3,500, has also been targeted at the enterprise. Worth noting, of course, that has not been updated in 4 years, almost 4 years. So when they showed that demo, the share price took a bit of a hit, fell $2 out of $183, something like that. So that was signaling to the market, this isn't a mass market product just yet. You can also slightly infer that from the name. It's the Vision Pro. Yeah. The same way you have an iPhone Pro, there might therefore be a Vision, which is not a Pro lineup, in a few years' time. So how significant is this for the wider tech space? I mean, we have companies like Magic Leap that have been doing a similar headset, but does it change because it has the Apple branding? Yeah, I think the thing that's super interesting right now is this product is not going to be released until next year, which means that Apple's got a year, basically, to try to convince consumers that they need it, that it has an application. That is good for the rest of the augmented reality, virtual reality space. Facebook, Meta has a product out there for $500, 7 times cheaper. It isn't quite as impressive, perhaps, as certainly this one looks to be. It's with a heavy caveat that when you get hands-on with it, maybe it's not quite as good as Apple would have you believe. That is good news for Facebook, because Apple will kind of be doing some of their marketing for them, right? The question really comes when they start bringing the price point down, getting these other models in there. Can it become a mass market product? You're not going to be using it, I imagine, as it stands on the tube, where you can't see the outside world quite as easily, but you might be using it in the privacy of your own home. So it looks as though it's an early step in what could be a big market. And then we're expecting a showdown with Meta. Yeah, so that's the thing, of course, that Meta is going to have a lower price point for now because it has a different business case. It's selling ads on these things in the, in the long tail of the product's lifespan. Apple made a big play that actually this is going to be, there might be some eye tracking in there. That is not shared with anyone. If you're looking at a website, their website does not know what you're looking at. We have not had those guarantees from Facebook. Knowing where you're looking is quite valuable if you're in the business of selling someone ads. So that is going to be a real bone of contention in the years ahead. Alex, as always, thank you so much. Our Quick Take, of course, specialized on technology. Coming up, Piraeus Bank Chief Executive Officer joins us exclusively to discuss the Greek elections and the economy. That's next, and this is Bloomberg.
politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Langs.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come. I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Welcome back to The Open, everyone. 30 minutes into the European trading day, and here are your top stories. The RBA surprises with a 25 basis point hike and says more tightening may be needed. The Aussie dollar jumps. Apple unveils its much anticipated mixed reality headset, but with the eye-watering price tag, compete with consumers and investors. Plus, the SEC sues Binance and the chief executive officer, CZ, for allegedly breaking securities rules. The crypto exchange calls the complaint disappointed and also misguided. Now, we're getting some breaking news out of China. We had been talking for the last couple of weeks about whether the Chinese economy cooling meant that there was some kind of policy support. China has now asked big banks to cut the deposit rate again to boost the economy. Now, this is just breaking on the Bloomberg News Terminal. State-owned lenders, including Bank of China, Industrial and Commercial Bank of China, and Bank of Communication, we understand were last week advised to cut rates on a range of products, including, for example, some of the deposit rates by 5 basis points and 3-year and 5-year time deposits by at least 10 basis points. And this, of course, is to try to stimulate the economy. Again, the move is to stimulate consumer spending, but also boost credit supply. So we'll see what that means for the strength of the economy going forward, but certainly it is having an impact on short-term, I guess, if not liquidity, certainly on credit supply. Now, the other story we're following very closely is the RBA. We had a wonderful roundup of the top news from RBA, surprising a lot of economists and certain investors by hiking more than expected. And the impact here on the rest of the world is traders really trying to figure out whether there is a read across between the RBA and the Fed. It's really at the margins, but actually, if you have the sticky inflation, and we heard from Classic Note also of the ECB, even if it's gone down from 6% inflation is still something that they need to deal with. European stocks practically unchanged. The FTSE, again, if you look at the FTSE and the DAX, they're kind of oscillating between green and red, but overall, they're pretty much unchanged. Let's also have a look at sectors that are on the move. Now, we brought you 3 stocks that we were watching very closely because they're some of the biggest movers: technology, auto parts, and energy on the downside. And then I'm looking at healthcare, media, and real estate amongst the biggest gainers. But if you look at technology, it's down 0.7%. The biggest gainer, healthcare, it's gaining 0.5%. So it's not a huge range of difference. Now, Greece heading to the polls again with a fresh election set for June 25th. The Prime Minister, Kyriakos Mitsotakis, took a better than expected 41% of the vote in last month's election, but he did fall short of the threshold to immediately form a government on his own. Well, joining us now exclusively, we're very pleased to welcome Christos Megalou. He's Chief Executive of Piraeus Bank, Greece's #1 bank by loans and deposits. Thank you so much for joining us. It's always great to catch up because you're a real bellwether of what investors expect, of course, of Greece and the economy. First of all, was there a vote of confidence? Because, you know, voters voted for Mr. Mitsotakis, which is seen as pro-markets.
Good morning, Francine, and I'm very pleased to be at the show again. It was a vote of confidence, and will, we believe, lead in the next elections in a stable government, which is what the country needs for the years to come. It is a government that so far has been implementing a number of policies that have increased the growth rate of the economy significantly. They have been in a position to increase exports significantly, and also foreign direct investment. So quite a lot to wait for the next few years to come for Greece.
What's your outlook for the Greek economy? So will it be able to have strong growth rates? Will we see them in the next 2 to 3 years? Is the trend sustainable?
Let's talk about 23 first. We expect 23 Greece to grow at around 3.5%. Which is, we estimate, double the European average. But we see a steady growth for the next few years at around the 3% mark. This is going to be underpinned by further foreign direct investment, further fixed capital formation, and a big boost in exports, which has been significant over the last few years.
How difficult will it be for you and the bank to actually further reduce your bad loans in order to bring the non-performing exposures ratio to within EU thoughts?
We have done a remarkable job in reducing our non-performing loans from the heights of 54% a few years back. We are now heading towards 5% of non-performing loans as a percent to our book for the end of the year, and trending towards the European average in the next couple of years to come. Very focused, very determined to go to European average very, very soon. But the 5% that we are guiding, it's a very good number considering where we have been the last few years.
We know that the Greek state also wants to divest from Greek lenders. How soon can that happen?
There is a policy in place that is mandating for this to happen by 2025. So we understand that the Hellenic Financial Stability Fund is working towards that goal and is already looking to hire advisors for this to happen. So I guess this is something we would expect to happen sooner than later.
So I was in Milan yesterday to also interview Andrea Orcel, the chief executive of Unicredit, and he says, look, the second half of the year could be trickier because it changes banking models as depositors want more for their money. Do you see that shift?
We do, and this is exactly what we are monitoring also extremely vigorously as we speak. On the one hand, we have the net interest margin going up. On the other hand, depositors will require a higher return for their money, and this is something we are working on. Overall, though, we think that what we call as NIM, net interest margin, would be towards 2.3, 2.4%, which is a very good rate for a European bank.
So what effects are you seeing on your business from higher interest rates, apart from that? Is there anything else on the way, customers behave?
Monitoring our portfolio extremely carefully. There are certain areas and certain sectors that we have to be a lot more vigilant than others. We don't see any deterioration of our portfolio so far, which is a very positive sign, but I can tell you we are extremely vigilant in actually monitoring how our clients behave and actually trying to assist in case we see any distress.
Is there a danger point for this kind of distress? And I was, if you look back at what we thought in October, a lot of people thought it could be, the end of the world because energy prices would skyrocket. We were also helped by mild weather. Where's the danger point in the next 12 months?
Mild weather and the energy prices, of course, helped a lot.
Yes.
Inflation is actually starting to ease. Greece, actually, in April, posted a 3% inflation. for the year, which is a remarkable number. Nevertheless, we do expect that the ECB will be raising rates by at least another 2 hikes towards the 3.75 mark. But still, we don't think that this is going to be really hit our portfolios significantly. So vigilant, focused, and making sure we try to help our clients if we see any signs of distress.
Are you seeing any signs of consumer behavior changing? So not necessarily distress, and I don't know if it's mortgages or something, or the way that they spend differently.
Greek spending, actually, for Greece, it's on the high, so we don't expect something significant there or more deteriorating to happen.
Yeah.
But overall, we think that this is within normal consumer behavior. We don't see something extraordinary.
All right, thank you so much for joining us. Piraeus Bank Chief Executive Officer there, Christos Megalou, with the very latest, of course, on the banking sector in Greece and also the economy. Coming up, the CEO of Evrock joins us to discuss his plan to rival U.S. cloud services in Europe. That's coming up next, and this is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this, and what the Fed does potentially?
This is so exhausting, and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Welcome back to the Open, everyone. 42 minutes into the European trading day. For the moment, markets unchanged. We look at the RBA and how they're dealing with inflation. The other big story that broke on the Bloomberg terminal about 10 minutes ago is Chinese authorities asking their biggest banks to lower their deposit rate for at least the second time in less than a year. This is according to people familiar with the matter. And this, of course, is a move to stimulate consumer spending and boost credit supplies. We'll have plenty more on the read across to China. But now Evrock looking to raise 3 billion euros to challenge Amazon's dominance in the cloud space. Now, the EQT-backed startup plans to do this by building 8 big data centers across the region, saying it wants to put an end to the foreign dominance of the European cloud market. Well, Matthias Astrom, the chief executive of Evrock, joins us now. Matthias, I like your fighting talk. You want to put, the end of world dominance, especially from the US. What does that take? So you're planning to build 8 hyperscale cloud centers across Europe over the coming 5 years, employing 3,000 people. Do you have all the financing in place?
We have investors that know exactly how much money we will need. And Europe needs this. We're completely dependent on foreign states for critical infrastructure. We've seen what can happen if you depend on other states for energy services and other things. So we're building a hyperscale sustainable cloud for Europe.
So why, first of all, does Europe need a sovereign hyperscale cloud?
So there are two. European companies or states basically have two alternatives today. Either you use the sort of the foreign clouds, which, by the way, are providing great services, but then you risk that foreign nations can look at the data and you may violate European privacy rules. The other option is to have your own data center, on-prem data center, which is terribly inefficient, not very secure, so it's really consuming a lot of energy. So most people in Europe are stuck between two bad choices, and we're going to change that.
Yeah, so Matthias, I have a lot of questions on this. I think the big US names have about 87% of the European market. So why has this not done before, and how difficult is it to take them on?
I think that we're in a very different sort of geopolitical situation than we were a couple of years ago. 2-3 years ago, it was okay to sort of trust other states. We've seen during COVID, we've seen during the energy crisis, that Europe needs its own critical infrastructure, and we're building that. The other thing that is happening is that a lot of tools are available now in terms of open source, so you can sort of build this a lot more efficiently than 10-15 years ago. And actually, we think we can build a better cloud, focusing on sustainability and a better user experience.
So what market share are you aiming for?
I think that for the European market, I think we'll have at least 20+%. A lot of that is on-prem today, so in own data centers rather than on a sort of hyperscale cloud.
And you need 3 billion euros. The
that's to start.
Environment, that's to start 3 billion. The funding environment is pretty tough at the moment. Do you think, it'll be different for you?
Actually, we started this journey when the market were starting to be tough already. So I think it will be sort of a combination of venture funding, strategic funding, funding from European Union, as well as debt.
Do you have an idea of where you'll put them yet already, like the location of these data centers?
I think the first 2 hyper centers will be put, one in the north of Europe, where you can get sustainable energy from hydropower, one in the south, where you can get power from solar, so France or Spain.
I was going to ask you, a lot of these data centers require so much electricity. Where does it, how much of that will be renewable? Is that part of your plan, like one of your priorities?
Yeah, so obviously everything will be sort of renewable energy. That's part of what we do. But I think the big part here is that on-prem data centers are terribly inefficient. And by moving from an on-prem data center into sort of a hyperscale cloud, you can save up to 90% of the energy. And that is really, so we plan to give back energy to Europe. There is also an opportunity to do data processing where you have sustainable energy available. Moving data doesn't cost anything. Moving electricity is very expensive. So when there's sunshine in Spain, we'll do processing in Spain. When there's wind in Holland, we'll do processing in Holland. And during the night, we'll do it in the north where you have hydropower.
And this, you think that renewable energy will be critical mass in 4 or 5 years? Because at the moment, we have a lot of it in Europe, but it's not always as reliable. The UK is very windy, and yet 18 months ago we didn't have enough wind and had to start up the old fossil fuel.
Yeah, so it's really that sort of peak power. And this is what we have, something called sort of an equal load balancer, where we actually can move data processing to where you have, so you train AI models, for example, where you have sustainable energy. So when there's no wind, you move it to sort of a different country. It's all going to be part of the EU or Europe to make sure that we're sort of complying with GDPR and other rules.
So, Matthias, when you look at the hyperscale cloud, is the space going to be more crowded? And actually, what does it mean for me as a consumer? This is kind of B2B, or will I, as a consumer, have to choose my provider? How will this space change over the years?
Yeah, we're focusing on helping all the businesses in Europe that will not be able to use sort of a hyperscale cloud today because of GDPR compliance, or that you're dealing with sensitive health data. So we really want to sort of provide Europe with the same sort of development platforms that a lot of the US firms have today, and really sort of empower a digital Europe.
Okay, what's your biggest challenge right now, apart from raising funds?
I think moving fast enough. Europe needs this. Yeah, of course, raising funds, but it really has to be done. And we're making it happen. And we're.
What happens, which is if you don't move fast enough, is there another entry that could come, or you're just going to fall behind?
I'm less concerned about that, but Europe needs this. I mean, it's part of the climate, helping Europe with climate. It's helping Europe with sovereignty. We need our own critical infrastructure.
Yeah, I mean, a lot of people say we also need chip makers, but they're not coming, or they're taking a long time to come.
We're doing our part to really help Europe on the critical cloud services.
Matthias, thank you so much for joining us. Matthias Astrom, they're the Chief Executive Officer of Evrock. Coming up, Giorgia Meloni faces a few challenges ahead. Among them is reviving Italy's economy through state-owned companies. We'll discuss that next, and this is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Could face bigger challenges next.
Was going to keep Rain World Cup. This is a 3.
As the economic picture does.
Is it the OK's getting ready to make a decision?
We are in a very uncertain environment because we are resetting geopolitics, value chains, interest rate environment, inflation, economic growth. That will shake the system and will create shocks.
The UniCredit Chief Executive there, Andrea Orcel, talking to me at the Italian Capital Markets Forum in Milan yesterday. Now, top of Prime Minister Giorgia Meloni's Italy First agenda is the creation of a national champions in areas from energy to fashion and luxury, and also a sovereign wealth fund to finance them. Let's get more now on that Bloomberg Big Take Scoop with Alessandra Migliaccio, our Western Europe economy reporter in Rome. Alessandra, great to see you today. It was great to see you in Milan yesterday as well. So how is the Prime Minister, Giorgia Meloni, implementing her new vision for Italy?
Good to see you too, Francine. Yes, it was a very exciting day in Milan, and we talked about exactly this. So Meloni is very fortunate. She has come into power at a time when she's able to change most of the heads of state companies. And we're not talking little companies. I mean, these are very, very big players. You have Eni, which is one of Europe's biggest and one of the world's biggest oil companies. Then you have Enel, very active in half of Latin America. It's an energy company. You have defense player Leonardo. So these are very large companies. And she was able to put her people in, and for 3 years. That means that even if something happens to this government, which, as we know, often happens in Italy with governments, they will remain. So she's putting in her people, putting in people who have a vision of nationalist vision of champions, which is what she's trying to convey. And basically what she wants for Italy is more power. She wants a more French model, she said in the past. She wants a model where Italian companies make a difference, where they can decide what's going on and where they're not being taken over by other foreign companies, which has in part been the case in the past.
So what about the Prime Minister's vision on China? It looks like she'll pull out of Belt and Road. What does that actually mean for Italian companies?
Yeah, that's another issue, but it's related because it's always this vision that Meloni has for the future and for Italy's role internationally. Now, this is interesting because, of course, she wants to befriend the United States. She wants to be a player. She wants, at least economically, to be accepted, and she doesn't want to be perceived as far right or not playing ball with the others. So she wants to please the U.S. and her allies, and she does want to exit the Belt and Road. But the problem is there's so many Italian companies that are deeply involved in China, partly because of the deal, partly because they were already, there are large companies like Fincantieri for shipping, or Brembo, a very famous Italian brakes company. They make brakes for Ferrari. They don't know what to do because although, they may agree in general with Meloni's vision, they're concerned that it's too quick. At least they've told us off record, it's very quick, and they're afraid they can't pull out fast enough, and it may damage their companies.
Alessandra, thanks so much for that great reporting. Of course, our big take on Giorgia Meloni looking to cement power by remaking corporate Italy. Our Alessandra Migliaccio, Western Europe economy reporter, joining us from Rome. Now let's also get to the Bloomberg. First word news, and Ukraine says Russian forces have blown up a dam at a hydropower plant in the south of the country. Kyiv says 10 villages and part of the city of Kherson face the risk of flooding. This as Russia and Ukraine both report widespread fighting along the war's front lines as anticipation builds for Kyiv's long-planned counteroffensive. Australia's central bank has unexpectedly raised its key interest rate and says more hikes may be needed. Well, the RBA increased its cash rate by a quarter percentage point to 4.1%, the highest level since 2012. That's as Australia's inflation remains well above target and labor costs jump. Economists were expecting rates to stay on hold. An industry lobby group is warning that the UK risks falling behind in key technologies, including AI and semiconductors. Now, Tech UK, which has almost 1,000 members, including Apple and Amazon, says the government needs to urgently overhaul its policies and regulations. Now, the report calls the UK a broken economy for growing startups and describes its regulation as expensive and awkward. And ECB President Christine Lagarde says inflation pressures remain powerful and borrowing costs will be raised further to tackle them. Now, the comments cement expectations for another interest rate hike at next week's meeting of the Euro Area Central Bank. Well, Lagarde reiterated there's no clear evidence that underlying inflation has peaked.
Indicators of underlying inflationary pressures remain high. And although some are showing signs of moderation, there is no clear evidence that underlying inflation has peaked.
And that's your Bloomberg First Word News. And that's also it for the European Market Open. Surveillance Early Edition is up next. We'll bring you full breaking news. That big story, of course, from China, breaking just 20 minutes ago. Extra support as China, we understand, has asked some of their big banks to cut deposit rates again. That would be a boost to the economy. And, of course, it's a move to try and stimulate not only consumer spending, but also boost credit supply. Full roundup of the markets next. This is Bloomberg.
says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. The RBA surprises with a 25 basis point hike and says more tightening may be needed. The Aussie dollar jumps. European stocks are, well, unchanged. Christine Lagarde cements expectations of another rate hike next week. The ECB president actually says price pressures remain strong and borrowing costs will have to increase. And Ukraine says Russian forces have blown up a giant dam in the south of the country, unleashing a torrent of floodwater that threatens residents and complicates the battlefields. Now, let's also check, of course, on the markets. The ECB saying consumer expectations have decreased significantly. Now, this, of course, is to put into context. We also heard from Klassknot in Luxembourg, I believe, a little bit earlier on, saying what they've done with interest rates is now starting to feed into the real economy. ECB saying that consumer expectations decreased significantly. It does not necessarily mean that they will change their projections for interest rate increases. Again, the market pretty much expecting a June and then a July hike. What happens in September is, of course, the big story. The other big story is China trying to put more stimulus in the markets to try and spur consumer spending there, but also credit supply. That will be something that will play out, of course, in Asian markets tomorrow. For the moment, European stocks pretty much unchanged. European stocks getting 0.1%. And then, again, the fallout, or at least the understanding of what the unilateral Saudi Arabia decision over the weekend to cut more production means for crude oil is still trying to work its way through 75.67. Now, European map. There's not always a lot of difference between what we're seeing in the CAC 40 in France or the DAX, but you can see there's a little bit of a difference depending on the composition of some of these markets. So the DAX actually gaining 0.1%, where a lot of the other ones are unchanged. So Bloomberg has learned that Chinese authorities have asked the country's biggest banks to lower their deposit rates for at least the second time in less than a year. Now, the move marks an escalating effort to boost the world's second largest economy. For more, let's bring in Bloomberg's Valerie Teitel. Valerie, this is a huge deal because we've been asking ourselves, really for the last month and a half, what policymakers can do to try and prop up the economy.
Yes, that's right, Francine. This might be the first hint that there might be more official rate cuts to come. We had Bloomberg sources reporting that state-owned lenders were advised last week to cut rates on a variety of deposit products, ranging from duration of 3 to 5 year deposit rates. It's the second time in less than a year that China has done this. The last time they did it was back in September. These official banks, they may adjust those rates lower as soon as this week. I think the market might assume that this could overshadow, perhaps hint that an official rate cut could come in the loan prime rate on the next time China announces those rates, which is June 19th, so less than 2 weeks' time. The HSI index, that's the Hong Kong index, popped on this news, popped higher. Dollar CNH, that's the Chinese yuan, that moved lower on this news. The Chinese renminbi has continued to weaken on expectations of China easing. And then their 10-year yield moved slightly lower. Now, that goes to say we have a lot more data coming out of China this week. On Wednesday overnight, so tomorrow very early in the morning, we get their trade data. That's their export and import data. The market is going to be watching if this export engine, this export growth engine model that China has relied on is still there. And then on Friday, we get CPI and PPI. Perhaps the lower growth impulse, the slower growth impulse in China will play through to softening inflation figures. And then from June 19th to 15th, we'll get the May credit data. That's new yuan loans, any new private credit that's been extended in the Chinese economy. That will also give us a good glimpse on just how well the Chinese economy is holding up. Now that we know that this reopening trade, this reopening growth burst that many were expecting has started to dwindle.
Yeah, thank you, Valerie. Of course, Beijing, we know, has rolled out a raft of measures to prop up the economy after a series of crackdowns in multiple industries, but also lengthy lockdowns due to COVID. Our Valerie Teitel there, looking at some of the market moves now. Joining us now is Nick Scullion, partner at Foresight Group. Nick, thank you for joining us. To do or not to do, this is a problem for policymakers in China. At the margins, they're trying to support the economy. What does it mean for the rest of the world?
Well, good morning, Francine. Good to be back. Thank you for having me. Yes, of course, big news out of China this morning, asking central banks to cut. Clearly, that has big implications on a global scale. If we see, stimulus in China, then we are likely to see commodity prices resurging. Inflation could be stickier on a global basis, which could cause policymakers headaches on a global basis, not least in the US, Europe, and as we've seen in Australia this morning, already raising rates overnight, which was a surprise.
But so what does it mean? I mean, what China's trying to do, right, is they're trying to stimulate consumer spending and boost credit supply. So first of all, do we actually believe the data that came out of China that was already worrying, or could it be worse than expected?
Well, that's always a challenge, isn't it, when we're dealing with that particular
Especially when
geography?
OPEC is also cutting supply. I mean, there's all these, I guess, alarm bells, right? I don't know how you interpret them.
Well, you're right, and we have to be very circumspect when we're looking at the data. But when we're thinking about, constructing our portfolios, what we're thinking about is what really matters here for global growth. And for us, what really matters is core inflation on a global basis coming down at the rate that we're being told that it is. We have seen, Christine Lagarde already saying this morning that there aren't major indicators that core inflation is getting back to where they need it to be. But we're really careful about looking at inflation and what that means for the next couple of quarters of policy decisions on a central bank basis.
So is there, and again, I guess if you look at the markets, they're unsure whether inflation is going to come down, far enough for central banks to ease off, or whether it's stuck at that 5-6% range, which is actually really tricky to get back to 2%.
Yeah, absolutely. And what we're seeing actually is, U.S. interest rate swaps, inflation swaps for next year down at 2.1% already. That's a bit surprising given where we are and given where we've been. I think that there could be a bit of a expectation effect that you've got anchoring from many of the analysts that are just looking at long-term economic forecasts and not really looking at the world around us. However, I think that there is a good case to say that core inflation follows headline inflation with a lag, and that is being somewhat underappreciated by the market. So we think that, the outlook for a soft landing has somewhat increased in the last couple of months. That potentially is being underappreciated by the market. We think that if there is a soft landing, well, that's broadly good news for equities. It means that interest rate policy can become much more stable, much more circumspect. We won't see rapid rate rises or falls. And if the discount rate is no longer what's pushing around valuations, it becomes all about earnings quality. And that's how we manage our portfolios, looking at the quality of earnings.
So first of all, what does a soft landing look like? I guess a slowdown in growth, but without a credit crunch, or we're starting to hear actually on both sides of the Atlantic, for example, some of the lending figures being significantly curtailed.
So I think a slowdown in growth is right, but what we really need to see is no major crack in the labor market. So we saw some really interesting data on Friday, where we saw, strong non-farm payrolls, but we also saw a rise in the unemployment figures. Those two coming together was interesting in how the market responded. However, the data shows that if the US sees a 0.3% increase in the unemployment rate, there will be a recession. That's what we've seen in the past. So we've come in just under that. What's actually frightening, though, is if you see that rate get to 0.5%, it tends not to stop until it gets to 2%. An increase of 2% would be pretty dramatic and would lead to a pretty severe economic recession, we think.
So when you look at earnings, and you're basically, I don't know whether it's stock picking or kind of trying to find value in it, is it exposure to China, or how do you make a difference between a stock that actually is time to sell and time to buy?
No, so for us, it's all about the quality of earnings. So it's the counterparties, it's the duration of the cash flows. And, we're looking for critical assets on the whole. So infrastructure assets, renewable energy, digital infrastructure, critical services to society tend to do well during recessions anyway. But counterparty is extremely important. So exposure to China would be problematic. Broader EM exposure would have the political uncertainty that we're looking to avoid at this stage. So it's companies that have high quality earnings from long duration cash flows, government counterparties, but with that inflation protection embedded within those contract structures that make the medium term an interesting perspective for us.
All right, Nick, thank you so much for coming on today. Nick Scullion, their partner
Francine.
at Foresight Group. Now, coming up, President Christine Lagarde remains hawkish in the lead up to the ECB's policy decision later this month. We discuss the central bank's rate path and the euro area economy next. This is Bloomberg. So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it's very different, and it's not something people have had to operate in for a long time.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Expected inflation to hold for longer. We're now at 6%. Potentially, we can have surprises on the decline of inflation. The ECB has raised very fast and a lot, and there is always a lag between when you tighten and when it takes grip on the economy. And I think we haven't given it time to take grip on the economy, so we may see a slowdown of the inflation very, very fast, as we have raised very, very fast. So potentially we're in a better situation than people expected. We got a boost from interest rates. Yeah. Everybody talks about the boost, nobody talks about the negative from it. But anyway, that is how it is. And we have a convergence of the deposit cost to that level. From the second quarter of this year, we are going to have a reverse where rates are going to hold, go up less, but the so-called pass-through is going to increase. So that will create a headwind for all banks. And I think the market is very focused on that, but in a way, it's important to be focused on that, but they're missing the whole picture. The whole picture is, one, Europe is going from minus 50 basis points to a lending rates of, I'll let you guess, 2.5, 2.25, 2.75. That is massive. When rates stabilize and it comes back down, fees rise. People stop investing in accounts of the bank and start buying back asset management products, unit-linked, increase their payments dynamic because transactions start again faster. So these things offset the compression from rates. And then I think for people who have been focused, and we're very focused, it is a trigger to be very, very focused on efficiency. And we're determined to get our cost to decline in spite of the inflationary environment. So for us, it means absorbing 500 million of adverse cost effect, and at the moment we are. So if you put it all together, maybe between 23 and 24, you're not going to see growth, or you're going to see more limited growth. But as this stabilizes, then from the second part of 24 into 25, you're going to see a lot more growth from the banks.
UniCredit Chief Executive Officer Andrea Orcelli there speaking at the Bloomberg Italy Capital Markets Forum. Now, as the full effects of the ECB's rapid tightening campaign continue to work through the economy, President Christine Lagarde says inflation pressures remain powerful. She added that higher rates will be needed to tackle them. Her comments cement expectations for another hike at next week's meeting. Now, for more, let's bring in Bloomberg's Western Europe economy editor, Zoe Schneeweiss. Zoe, thank you for joining us again. We also heard from Classic Note explaining the read across that they hiked rates. When are we expecting it to be fully priced into the economy?
So this takes a while. As you know, transmission, the UniCredit CEO just mentioned that. It takes a while for them, the hiking rates, to actually feed through. So we're seeing it in some areas already. Lending is slowing. But the question is now with inflation itself, up until now, all the slowdown we've seen in inflation, and has slowed down significantly. Back in October, it was over 10%, and now it just was, it dropped down to 6.1. And that now means that all that has been because of energy prices. The base effect with energy. A year ago, energy was soaring, and so now, a year later, those energy prices, that then slows down. But the actual, what the ECB is doing has not yet actually shown up in inflation rates. So that can take up to 18 months. So we still have a bit of time there, which is why some policymakers say we'll hike next week, we'll hike again in July. But after that, we probably just can hold and wait for a while, whereas some of the more hawkish members have said probably we need to think about September as well.
Yeah, so talk us through the trend for inflation. So at the moment, it's come down quite rapidly, and we saw that in the numbers. Yeah. But it could get stopped. This core inflation could get stopped at the 5.5 level.
Yeah,
I guess.
Exactly. Core inflation is the one that policymakers now really have shifted their attention to. Of course, their mandate is on headline inflation, which is 3 times the actual rate that they want. They want 2%, and they're at 6.1. But core inflation has stayed much, much higher, and the danger is here, and economists are predicting that in the third quarter, so the July through September period, core inflation actually will be stronger for headline inflation. And you mentioned Klaas Knot, the Dutch central banker. He said today that now they're seeing second-round effects. They're seeing this high energy prices actually moving into services, and they see them in wages. And that means just that strong inflation is staying entrenched, and that means even if the ECB, let's say, holds in July, they might then have, holds after July, they might then have to stay at that level for quite a while.
Zoe, thank you so much, as always, for some great explanations. Our Bloomberg Western Europe economy editor, Zoe Schneeweiss. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Australia's central bank has unexpectedly raised its key interest rate and says more hikes may be needed. The RBA increased its cash rate by a 0.25 percentage point to 4.1%, the highest level since 2012. That's as Australia's inflation remains well above target and labour costs also jump. Economists were expecting rates to stay on hold. Now, the SEC has accused Binance of engaging in a, quote, extensive web of of deception and a calculated evasion of the law. The U.S. regulator also alleges the crypto exchange misled investors about its trading controls. Binance says it engaged with the SEC in good faith negotiations and will defend the platform vigorously. The list of digital tokens deemed as unregistered securities by the SEC now spans over $115 billion of crypto assets. And an industry lobby group is warning that the UK risks falling behind in key technologies, including AI and also semiconductors. Tech UK, which has almost 1,000 members, including Apple and Amazon, says the government needs to urgently overhaul its policies and regulations. The report calls the UK a broken economy for growing startups and describes its regulation as, quote, expensive and also awkward. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. Now, flooding fears as Ukraine accuses Russia of blowing up a giant dam in the country's south. We'll bring you the very latest on that story, and this is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
News breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Ukraine has accused Russian forces of blowing up a giant dam in the country's south. The explosion has unleashed a torrent of floodwater that threatens residents along the Dnipro River. Now, let's get more with Bloomberg's Ross Matheson. Ross, what do we actually know so far?
Well, we know there's been a catastrophic amount of damage to this important hydroelectric power plant, which is on this dam in the south of Ukraine. You can see there's footage of floodwaters cascading out of the area at speed and what looks like significant damage to whatever was holding those waters back. Of course, Ukraine says that Russia has blown up the dam. And of course, there was also evidence that Russia was mining the dam some months ago. And what we know is those waters are moving south. They're moving towards key cities, including Kherson, which Russia occupied for a period after it invaded last year. This is really the economic heartland also of Ukraine, the south and the east of the country, important areas for agriculture, important areas for industry, important areas also for the environment of Ukraine. And this floodwater could do major damage to all of those things, perhaps moving even towards Crimea itself. It's very early days. The Ukrainians are warning there could be catastrophic damage to the area from this flooding. There could also be some sort of risk to the nuclear power plant, the Zaporizhzhia nuclear power plant, which is idle, but it does use these waters for cooling, and there are backups for that at the moment. But if those backups run out, there could be key questions about the safety of that nuclear plant going forward.
And we know, of course, that it's a developing story. It's extremely difficult to know what happens next. But strategically, you've laid out why it's important to Ukraine. Is there any insight into what the next step could be in this?
Well, it comes, of course, as we know that Ukraine has either been gearing up or has already begun some sort of counter-offensive in the east and the south to reclaim land back from Russia. We saw fierce fighting in the Donetsk area in the past couple of days. And so this kind of comes at a time we're expecting a pickup in activity on the ground, and Russia obviously concerned that Ukraine is massing its offensive. And if indeed Russia did blow up this dam, it's probably designed to push those Ukrainian forces back, to make it very difficult for them to make advances on the ground. Of course, occupied with a big humanitarian disaster, environmental disaster, and so on in the area across this key river, the Dnipro River. And Russia may just be wanting to sustain its existing positions rather than trying to hold Ukraine off, because the longer the Russian troops can sit there, obviously, the more complicated it becomes for Ukraine. If they can see through this offensive in the coming months by doing damage in the area, a la via this dam, then perhaps they'll be a bit successful in the longer term. So it might actually enable Russia to hold off Ukraine for a bit longer as a result.
Ros, thank you so much. Ros Matheson with the very latest, of course, on Ukraine. Coming up, we'll go back to the markets after the RBA's surprise hike. We'll be joined by Adrian Durham as well, FNZ Chief Executive. He joins us for that conversation. Then we have an important conversation also on crypto. The other piece of news is China asking some of the big banks to cut deposit rates again to boost the economy. All of that coming up, and this is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
This is Bloomberg.
The RBA surprises with a 25 basis point hike and says more tightening may be needed. The Aussie dollar jumps, European stocks are lower. Christine Lagarde cements expectations of another rate hike next week, while the ECB president says price pressures remain strong and borrowing costs will have to increase. And Ukraine says Russian forces have blown up a giant dam in the south of the country, unleashing a torrent of floodwater that threatens residents and complicates the battlefield. Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get more on the markets as the RBA surprises traders with another hike, raising its cash rate to 4.1%, the highest since April 2012. So what will this mean for other central banks going forward? Well, joining us now is Adrian Durham, the founder and chief executive officer of FNZ. Adrian, thank you so much for joining us. Now, we link central banks to what you do because, of course, everything changes when interest rates go up for financial services.
Yep.
First of all, how do you see this ever-evolving interest rate hikes, ever-evolving technology, and change in operations impacting the way we bank and manage our assets?
Yeah, sure. So I think the trend that we really see in financial services today is about, and particularly in wealth management where we operate, is about ever-increasing personalization of these services. It's all about me, how I achieve my goals, and how I can have a solution tailored specifically for me, which I think is something we've seen in many other industries over the last 20 years, but which has just come to the sector. And I think that's directly relevant in a world where inflation is higher. You know, people have more challenging goals and they need more challenging solutions to achieve those, and it's all about personalization.
Adrian, you have an amazing story because you founded,
Yep.
this company FNZ, and it's amazing the growth trajectory that you've seen. And now you're launching more products and also partnering with some banks. What surprised you the most in this journey to wealth management?
Yeah, I think so. Wealth management is an extremely complex industry, which I think is why it's taken longer for the impact of technology to really translate into a benefit to the consumer. But the approach we've taken is very much to partner on a B2B basis with suppliers of wealth manager, take over their back office, move it onto a modern technology platform and serve it back to them in a way which really lets them focus on their customers, personalizing, digitizing, and having transparent and fair services, which I think,
So this, I mean, I find this fascinating, and it's really an amazing story in the number of accounts you've been able to open. It's basically commoditizing the back office so that individual banks can give that premium service to their clients. Is that the way the industry will continue going as a whole?
Exactly. So, you know, as a consumer in this space, I care about how my money is invested. I care about the advice I receive and the trust I have with my advisor. Everything else kind of needs to fade into the background, and that's where technology and automation and extreme automation of these processes can really enable the things which matter to be the focus of those in the sector, and so that's absolutely what it's about.
So I guess the difficulty is, do you get disrupted by AI? We're trying to figure out exactly what AI means for markets and the way things are open, even for example bank accounts.
Yeah, I think. I don't think we necessarily get disrupted by AI, but it's an enormous benefit in terms of us enabling us to take automation to the next level. The more and more we can take complex processes, scale them, require less people. I think AI is a key enabler of that. And a technology that we deploy already to take automation to the next level.
And again, what's amazing is that you come from a really privileged position of understanding both wealth managers are doing right and doing wrong. Are we expecting consolidation phase? Already it started, but if you don't have a good value proposition and you're basically opening the accounts for them, like, will they have to merge?
I think we actually don't. We support a model which is not necessarily consolidated. If we take all the pain away of not just opening accounts, but funding those accounts, investing those, providing the reporting and managing all the regulation, then that enables a model which either operates at a lot of scale, and we have a lot of customers who are very large scale global banks, but also enables the independent model, which actually has been the general trend for a long time. So I think it supports both ends of the scale spectrum and means actually you don't necessarily need to consolidate, at least as a provider of financial advice, in order to provide an efficient, cost-effective and personalised service for your customers.
I know you've partnered, for example, with Virgin Money to deliver an app for retail investors. You're expecting a lot more of these apps. Like, where are you seeing growth in terms of business model, but also what you're working on?
Yeah, we definitely enable and are excited about this world where we can, enable people to connect directly in a more accessible way with their financial goals and their wealth, and do that through technology and apps. And in our case, enabling that through partnerships with people like Virgin, trusted brands. And I think that's very much what drives our B2B model, very much drives much better model of delivery of services to consumers. I think we should also, wealth management is complex, and so a lot of people are still going to solve this problem, in combination of apps with people and trusted advisors, because the complexity is high, and ultimately that's a problem which is solved by a trusted relationship.
And I guess that also changes with interest rate rising. Does it impact your world?
I think interest rates rise, but inflation has risen as well. So real investment returns are still not that different to what they've always been, which means over the long term, people are going to still invest in growth assets and benefit from growth assets. And so it's just as important as ever for us to provide services which enable people to save regularly, and to take risk. And so I don't see that fundamentally changing, except over the very short term when things change quickly.
Adrian, you're also one of the most interesting. I mean, you're a founder and chief executive in a fast-growing company that's doing very well. Like, longer term, what's your plan for the company? Would you ever sell?
I think we've just we built a very successful business in the UK. We've expanded that internationally. And just recently into the US market, which is the largest scale wealth management market by multiple. And so we're very focused on executing that growth. We've made a lot of progress, and so executing that, which I think is a multi-year story for us, still is very much our top priority, rather than thinking about any other potential future liquidity event. I think we're actually just at the relatively early stages of what we can grow this business in.
Is the US harder than the UK?
It's actually, I think, is fundamentally the same set of challenges. Very dated technology infrastructure that, in this technology-enabled way, has an adverse impact on the customer experience. So I think the opportunity in the US for us is exactly the same as what has helped us to prosper and be successful here and in Europe. And so we're very excited about that. And when you have a business in one country and you can apply it successfully to many others with effectively the same solution and the same benefits, that's very exciting.
So, Adrian, apart from market share, what's your biggest challenge that you have to get right? Is it how you process data, or some of the data centers?
I think actually, in this space, it's if you have a successful business model and proposition, which we do, it always comes down to execution and sort of day in, day out execution, and in our case, managing that across 26 different countries. That's where the complexity and the challenge lies. And that's where we focus.
Okay, wonderful to have you on. Thank you so much.
Thank you very much for your time,
Adrian. I'm sure we'll interview you again.
As
you have breaking news. Adrian Durham, the FNZ's founder and Chief Executive Officer. Now, we're also getting some breaking news, as we usually do, around 9:30 a.m. UK time. This is May construction PMI rising to 51.6. Again, anything above 50 means that it's an expansion territory, and it is actually, if I can get my words out, better than expected. Economists had forecast a 50.8 figure. It's coming up 51.9. 6. Now, coming up, we'll speak to the chief executive officer of a software company that's just launched in the UK as a new report calls Britain a broken economy for growing startups. That's coming up next, and this is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Today, following the worst ever year on record, bonds are back. Bloomberg is live from PIMCO headquarters in Newport Beach, California, sitting down for exclusive interviews with CEO Manny Roman, income fund manager Dan Iveson, and more as the biggest names in fixed income reveal their bond market forecasts. It's a special episode of Bloomberg, The Open, with Jonathan Farrow at 9 a.m. Eastern, only on Bloomberg Television.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition at Francine Lacqua here in London. Now, a group of almost 1,000 tech companies has warned the UK risks falling behind in key technologies like AI and semiconductor. That's if the government does not urgently overhaul its policies and regulations. Well, lobby group Tech UK has called Britain a broken economy for growing startups. But there are tech companies that are actually still choosing the UK, like HR and payment software startup Rippling. Now, to find out why, we're joined by Parker Conrad, the Chief Executive Officer and co-founder of Rippling. Parker, thank you for joining us.
Thanks for having me.
This is exciting because you raised quite a lot of money quite quickly, and this is to basically kickstart something in the UK that would be what a template for the way that HR manages things elsewhere.
I think that's right. Yeah, Rippling's an all-in-one system for payroll and HR and a few other things as well, and we're launching this week into the UK.
And so what happens if it's successful in the UK? I mean, do you see the UK as a template of what could happen in other European countries or even other jurisdictions?
Yeah, I think that's right. I mean, we think of the UK as sort of the best market for tech early adopters in Europe, and this could be the first step for us.
Yeah, and we've seen a number of big Wall Street firms, right, trying to do the same with bank cards. How long do you have the UK experiment to see whether it works and you roll it out in other European countries?
We'll see. I mean, it depends how well it goes. I think it could be quite quick. I think we're establishing sort of a presence in a bunch of different places.
Talk to me a little bit about, first of all, the problem with legacy payroll providers. Like you own this market, certainly in the US. Like, why was there an entry point?
Yeah, I think one of the things you see in the UK market in particular is that you have a lot of different systems that need to be brought together to run payroll. You have usually an HRIS system, something for annual leaves, for pensions, for payroll. You've got to send files over to your bank. There's a lot of manual process going back and forth with this. What we do with Rippling is we say, hey, look, it makes no sense to have all these things be separate. If you bring them all together into one system, you just go in, it looks good, you click a button to click submit, and the money's on its way to your employees. Rippling's a 2,000-person company. I personally run payroll for our company across employees in a dozen different countries for our business, and it makes it really easy for all of our customers to do the same.
So how much are you expecting to grow? I mean, I don't know the market share in the UK or whether you even have a global figure.
We, Rippling is, as a business, we're roughly doubling year over year. In the UK, we've got a core group of about 15 to 20 people that are working in our office here just to kind of kick things off, and we expect to sort of triple or quadruple that team this year.
Parker, I mean, some of the figures around Rippling are quite incredible. So you raised $500 million in less than 12 hours. You have a valuation, we understand, of just over $11 billion. And this is also because SVB collapsed. Talk us through the linkage.
Yeah, so what happened is in the United States, the way things work is that companies actually send payroll funds to their payroll company a few days ahead of when their employees get paid. We used SVB as the sort of rails for a lot of our banking in the US for our customers. And so when the bank collapsed, I woke up on a Friday morning and discovered unexpectedly that all of the funds that we were paying out to our clients' employees were still stuck at the bank in receivership. We made a very difficult decision in order to make sure that people got paid. We wired about $130 million of our own capital to JP Chase, and essentially double paid the payroll to make sure that people got paid that day. And as part of that process, we also kicked off a quick fundraising round to sort of make sure that we had enough capital to be able to do that.
I mean, it's a big gamble if then they hadn't guaranteed what happened at SVB.
Yeah, that's right. I mean, when we decided to do that on Friday, it wasn't totally clear what was going to happen. By the end of the weekend, of course, the FDIC stepped in and all the funds were released on Monday morning.
Yeah, I feel like that weekend is tattooed in my brain, like many of us.
Yeah, it was a stressful time.
I mean, did it make the strategy is basically you're I guess trying to do good. Does it make customers more loyal when you take difficult decisions? You could have lost $100 million. Is that fair to say?
Well, I mean, we thought it was just there were hundreds of thousands of, in this case, Americans that were expecting to be paid, and we felt very strongly that our clients had sent us this money, and we were going to make sure that it got delivered to their employees.
So, Parker, by now, I guess, entering the UK market, do you think it changes this prospect for UK businesses, especially the small and medium enterprises that are really the backbone of the UK economy?
Yeah, I think a lot of UK businesses spend, 5 or 6 days a month, even small businesses, dealing with payroll. And so I think we can take that and really dramatically cut that down. Like I said, I spend, probably just, a few minutes or just a few hours a month running payroll for our 2,000-person multinational company. And so I think we can really reduce the time and the administrative burden on businesses. That's required from a lot of these processes.
Yeah, and it means that they're more, we talked about this, it basically means, they can do more strategy, more of the important stuff that makes their company grow. After the UK, what's next? Is there a country or a region that you want to expand in?
I think for us, we're looking at sort of working with the EU market, but for right now, we're focused on the UK.
So again, this is a one-stop shop to look at HR, IT, and finance globally. Do you have to have conversation with the government, or no? It doesn't really. This is a private company. You don't have to get the go-ahead or anyone from regulation.
Well, it depends country by country. Okay. So, in the UK, for example, we work with the HMRC to make sure that we can right. file and pay taxes on behalf of our customers and help with that process. And country by country, there are sort of different processes to follow to sort of make sure that you're set up to work with the governments in those countries.
And again, do you need data centers for this, or how to process? How does it work?
Yeah, so we set up we set up infrastructure so that clients can choose where they want their right. data hosted, because obviously that's really critical when you're operating in these right. different markets for businesses to be able to have that choice.
And I imagine that changes, right, if you're a European-based company than if you're in the US because of rules.
Of course. Well, a lot of businesses, in the EU in particular, want to make sure that their data is hosted there.
Yeah. Okay, Parker, what a fabulous, interview. Thank you so much for making the time for coming on, and we'll get you back on in like 3-4 months to see how it's going.
Thank you very much.
Parker Conrad, Chief Executive Officer and co-founder of Rippling. Coming up, Prime Minister of Italy, Giorgia Meloni, faces a few challenges ahead, key among them reviving Italy's economy. We'll discuss that next, and this is Bloomberg. So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it's very different, and it's not something people have had to operate in for a long time.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition of Francine Lacqua here in London. Now let's get straight to a Bloomberg Business Flash. Here's Leanne Gearns. Hi, Leanne.
Hi, Francine. Apple has unveiled its first new major product category since 2015. Its much anticipated Vision Pro mixed reality headset comes with a price tag of around $3,500. Meta's industry-leading headset sells for $1,000. Now, Bloomberg understands Indian education startup Baiju has elected not to make further payments on a $1.2 billion loan after a dispute with lenders. The move escalates a conflict that could jeopardize the future of one of India's highest flying startups. Baiju has been trying to strike a deal with creditors to restructure the loan while also seeking to list its tutoring unit next year. China's Evergrande's property unit has delivered a delay earnings report that may bring its shares closer to a resumption of trading. Evergrande Property Services Group reported a profit of just under $200 million for 2022. That's reversed a prior year loss but fell short of 2020's result. The stock of China's most indebted developer has been suspended for more than a year. Global news powered by more than 2,700 journalists experts and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. Now, top of Prime Minister Giorgia Meloni's Italy First agenda is the creation of national champions in areas from energy to fashion and luxury, and a sovereign wealth fund to finance them. Now, for more on all of that, our Bloomberg Big Take Scoop, let's bring in Alessandra Migliaccio, our Western Europe economy reporter in Rome. Alessandra, thank you once again for joining us, and congratulations on a great Big Take. How is Meloni implementing her new vision for Italy?
Thank you, Francine. Thank you for having me. Well, Meloni is essentially putting all her people in very strategic posts. Some of that is good luck. She has the luck to be in power at a time when a lot of these posts are coming up. And so she can nominate people in very big companies. We're talking about things like Eni. Eni is one of Europe's and one of the world's biggest oil companies. Enel has assets all over the world. It's an energy company, particularly Latin America. There's Leonardo. It's a huge defense company. So they're very strategic companies, important all over the world. They make a lot of money. And she's putting people that she believes, will continue her vision, even if the government happens to fall, which we know in Italy happens often. So it is really a strategic vision that will go on even after she's gone.
So what do investors think of this? If people are concerned about when she came to power because of her far-right, populism ideas, have they done a reversal on this?
Well, here's the thing. She's playing a very fine game, and so far it's working. I think essentially, internally, she's still that populist, anti-immigrant, anti-LGBTQ rights person, but more and more outside, externally, and from the economic point of view, she's very wise and she's being a moderate. She is not. Markets are taking it very well. She's not doing anything uncautious on the economy. She's being careful about debt, careful about deficit, which is a huge problem for Italy, and we can see that with the spread. The spread between Italian and German bonds has not really moved that much, and it's much lower than it was a year ago. So her strategy is working of this moderate stance outside the country.
What about her vision on China? It looks like she'll pull out of the Belt and Road. What does that mean for Italian business?
So this is a real problem for Meloni because she has this nationalist view, and part of her whole program is also she doesn't want to alienate the U.S. in any way. She wants to be a good ally. She wants to show she's playing the game and she's not an outsider. And so she wants to pull out of Belt and Road, but Italy has over 2,000 companies involved in China. They're heavily involved. You have companies like Fincantieri, the big shipbuilders. You have Brembo. They make brakes for Ferrari, for example. And they're very worried because it's happening really fast, and they were very involved. So they may not have time, if Italy pulls out and China retaliates, to protect their businesses from what may happen.
All right, Alessandra, as always, thank you so much for joining us. Great reporting there on The Big Take with Alessandra Migliaccio, our Western European economy reporter in Rome. We're also getting some breaking news. We understand that German and Indian companies have been nearing a deal to build submarines in India. We'll, of course, get you more news on that. This is just breaking news, just crossing the Bloomberg terminal in the last 1 minute or so. Now, Bloomberg Surveillance Early Edition continues in the next hour, a full market roundup. This is Bloomberg.
Manchester, not London, is the best place to find a new job in the UK. That's the surprising finding of data analysed by Bloomberg. from breed recruitment. While you might think that London is the biggest pool of jobs, which it is, Manchester is leading the way when you look at the number of jobs per local worker. Thousands of voters in the so-called red wall seats flipped Conservative in the last election, hoping that the Conservative government would be able to bring more wealth and prosperity to their area. However, the data still show a country where employment prospects are thin on the ground in large pockets of the northeast, northwest, and areas all around the coast. Aside from Manchester, the only areas that are really leading the way are Cambridge, Reading, and Milton Keynes, indicating the good news for the rest of the UK might stop there. With Prime Minister Rishi Sunak facing the prospect of a general election as soon as next year, the pressure's now on for him to find ways to spread wealth outside of London to some of those more neglected areas. In Chancellor Jeremy Hunt's budget, he unveiled plans for 12 new low-tax investment zones around the UK and £760 million of spending on infrastructure and regeneration. Manchester's one of the oldest devolved areas in England, and there are signs that that's really beginning to pay off. What's on Jeremy Hunt's plate now is whether he can spread that success to other regions.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions. This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The RBA surprises markets with a 25 basis point hike and says more tightening may be needed. The Aussie dollar jumps. Apple unveils its long-awaited mixed reality headset, but investors are skeptical of the eye-watering price tag. And the SEC sues Binance and the CEO, Changpeng Zhao, for allegedly breaking securities rules. The crypto exchange calls the complaint disappointing and misguided. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. And Kriti, bit of softness in markets today, a bit of softness in the data stateside, particularly on services coming through yesterday.
Yeah, it all comes down to that question of, are we getting closer and closer to that recession that I think a lot of people have been predicting is just around the corner for 2 years now, Anna. But now as we get data like the services ISM stateside yesterday, this suggests, well, maybe that slowdown in the biggest part of the U.S. economy, well, it's coming way faster than we expected. And that really weighed on sentiment in yesterday's trading session, largely weighing on sentiment today as well. As you see, futures really down about 0.1%. And again, this is not a massive move to the downside, but given the context in the last couple of days, futures have kind of remained unchanged at this time. This is, I would say, a little bit more conviction in the idea that it is a little bit of a down day. You're seeing that as well when it comes to the bond market. The idea, again, that perhaps the Federal Reserve needs to be repriced. You're looking at a 2-year yield here that's down by about 2 basis points, 444 on that level. What's interesting here is that we're about a week away from the next Federal Reserve meeting, and we're here talking about whether or not the Fed needs to hit pause. I mean, that's what the market is pricing, but if you were starting to see a real slowdown, at what point does the market interpret that as a need to cut and therefore pushing the Federal Reserve? At least that's going to be the kind of conversation we have in the coming days as we get closer. As yields come down, it really influences the dollar as well, bringing that down. What's interesting to me, though, Anna, is just 24 hours ago, we were talking about this massive voluntary cut from OPEC, putting a floor under prices, and yet here we are again on NYMEX crude, testing that 70 level, down about 2.7% already. So what does that say in terms of the recessionary calls around the world? And speaking of those recessionary calls around the world, let's take a quick moment moment to look at what's happened overnight in Asia, because you saw a little bit of a mixed picture. You saw some real outperformance over in Japan. The Nikkei higher by almost 1% there, but the Hang Seng, the Chinese index, of course, unchanged, underperforming the broader gains you saw in the region. Worth mentioning, though, the real highlight was coming from the RBA, the Australian Central Bank. You are seeing strength in the Aussie dollar here after a surprise rate hike, as you mentioned at the top of the show. What does that say in terms of tackling inflation? Again, just a week away from the Federal Reserve meeting stateside, you are seeing strength in the Aussie dollar higher by about 0.6%, as well as a little bit of a bump in the Aussie yield as well, Anna.
Yeah, really interesting, the RBA story, because even if there is no direct read across into the Fed or any other geography, there certainly had been, of course, this was a central bank that had been on hold and then starts to hike again. And so does that give us pause for thought when we come to think about central banks and our expectations there? This is the picture for European stocks then, on the back foot, down by 0.6% over in Italy, down by less than that in most of these markets, but modest weakness coming through, 0.5% lower on the London market. Healthcare providing one area of green, but most of the sectors are now in negative territory as we deteriorate a little bit as we go through this morning's session. One area of brightness has been the energy story, at least, one area of weight has been the energy story. Brent crude is down by 2.5%, and that is weighing on energy stocks, and we'll look for this to be replicated stateside perhaps, but after that initial bounce in response to the Saudi action, as Critty, you pointed out, we're now seeing weakness in the oil price, down by 2.4% on Brent crude, and that is having an impact on those stocks that make their money from oil. Speaking of commodities, natural gas futures really in focus here when it comes to Europe, and we're not seeing much movement in today's market, but yesterday we saw a really big jump, a 20% jump. This is like engineering projects. On the home building front, we're down to levels of home building we haven't seen since 2009 as rates rise. The euro at 106.99, so flirting once again with that 107 or just below the 107 level. We heard Christine Lagarde at the ECB reasserting those expectations in markets. It seems that we'll get more hikes coming through from the ECB, including next week. But then look at inflation expectations. They have softened, and that is, though, quite a volatile number. Lots to discuss with our guests then, Critty.
Yeah, absolutely. And at the top of that list, perhaps that surprise decision from Australia that seems to be having a kind of little pause for thought impact on investors around the world at the moment. More on that, which unexpectedly raised its key interest rate to the highest level since April of 2012 and kept the Bloomberg Markets reporter Justina Lee. Justina, look, you cover central banks from around the world. What is kind of the thinking here in Australia, a country that noticeably has been having a hard time adopting the tighter policy regime, but also really tackling inflation?
I think the Australian Central Bank is finding itself in the shoes that a lot of monetary policymakers are in right now, which is that headline CPI has kind of crept down a little bit, but at the end of the day, it still seems very far from the target of around 2 to 3%. And headline CPI and core CPI is still like stickily high. And so putting together all of these things, I think that's why they decided to surprise markets with a rate hike and even signaled further tightening. Now, looking forward, economists are a bit split right now. Some see maybe, more hikes coming forward, and some are kind of expecting a pause anyway, because people are kind of expecting to see a bit of a slowdown in Australian growth, which should help curb further price increases as well.
And they did certainly reference the wages story, which looked quite standout in terms of the wages that are being agreed in Australia. Let me ask you, whilst we have you, Justina, about what's going on in China as well. China asking big banks to cut their deposit rates, again, to boost the economy. The support for the property sector in particular in China, very much mentioned last week by regulators and also talked about in markets today.
Yeah, exactly. I mean, that's like a completely different path from the rest of the world. But I think what China has experienced is kind of disappointment in what that post-COVID reopening boost has proven to be. And so now we've seen worsening data across, retail sales, industrial profits, the property sector. And what this move does is, it encourages banks to cut their deposit rates, which hopefully will mean they get to lower their lending rate and get money growth going again. But I think, in terms of the currency, what we have seen is further weakness in the yuan, and that's something that's, totally to be expected given that China's going in the opposite direction from, especially the Fed right now.
Yeah, the monetary policy conversation stands in stark contrast, doesn't it, Justina? Thank you very much. Thanks for joining us. Bloomberg's Justina Lee with reflections on some of those big macro themes this morning. Let's get to the corporate agenda. Apple unveiled its long-awaited mixed reality headset at its annual Worldwide Developers Conference with a hefty price tag of $3,499. CEO Tim Cook spoke about the new product yesterday.
So in the same way that Mac introduced us to personal computing and iPhone introduced us to mobile computing, Apple Vision Pro will introduce us to spatial computing. This marks the beginning of a journey that will bring a new dimension to powerful personal technology.
So the future is spatial. Alex Webb of Bloomberg Quick Take joins us with reflections on this latest offering then from Apple. And we saw the stock stumble a little bit as they announced that price tag. Is that because the market worries that not enough individuals will pay, or that actually it isn't aimed at a mass market?
Yeah, it was interesting. There were two dips to the share price over the course of the sort of 2-hour presentation. The first one came when Apple showed the first use case that it saw, at least for this product, and it was businesses. Investors took that to mean this is a product they're going to target firstly at the enterprise. You can also partly infer that from the device's name. It's the Vision Pro, in the same way that we have the iPhone Pro. You can therefore perhaps suspect that sometime later down the line there'll be a non-Pro version that's a little bit cheaper. And that gets to the second idea. The price point, $3,500, $3,499. It had been reported it was going to be in the $3,000 range, so it was a little bit more expensive than that. That signals to the market this is not likely to be a mass market product. Mark Gurman, our colleague, has reported in the first year, which will be next year, not this one, Apple perhaps only expects to sell 900,000 units. It's quite a lot for a new product category, considerably less than the iPhone.
Well, during this unveiling, Alex, they also talked about some of their other products, like a new version of their MacBook, for example. To me, that immediately signals what the ripple effects are for the chip sector, which brings me to another story overnight. TSMC, specifically lowering their CapEx as a result of perhaps the chip demand that's slowing as well. What can you tell us about that part of the business?
Yeah, they'd already given a range of how much they expect to spend building out new capacity. It's going to be $32 billion, sort of the lower end of that range. The readings people take away from that is that they're not expecting a massive resurgence in demand, not least for laptops, but also for smartphones, which in the case of Apple is the lion's share of its business. Still, there had been some hope that the demand for AI chips that help with AI, might drive some demand at TSMC. It does make the chips for NVIDIA, the sort of equity star of the past few weeks, but it's still a far smaller part of its business than what it does in making smartphones. So they're not going to be benefiting from that just yet. They may do in the years ahead.
Let me get your thoughts on crypto while we have you, Alex. The SEC's Binance lawsuit then, no doubt striking fear into many with exposure to the crypto space. Accusations of mishandling customer funds, misleading investors and regulators, breaking securities rules, all denied by Binance, but a long battle ahead perhaps.
Yes, and it's certainly sent a further chill through the crypto sector. One person in the Bloomberg story said that it was a continuation of the crypto nuclear winter. Key thing here really is whether these are considered to be securities. The SEC is now saying that they identified 12 things that are traded on Binance's exchange that it thinks are securities. Therefore, if it's in breach of security law, that's a big problem. Leads to more regulation. That's a big problem as far as Binance is concerned. Leads to more regulation and is not something that crypto investors look on too positively.
Alex, thanks very much. Alex Webb joining us there with a number of tech themes and the crypto news flow. And if you're interested in that story on Binance, then catch Bloomberg Crypto. That is today at 1 p.m. New York time, 6 p.m. in London, the weekly show that covers the people, transactions and technology shaping the world of decentralized finance. Coming up on this program, Italy's first female prime minister looking to drive change in the economy, starting with corporate Italy. That's our big take story. We'll get full analysis from Italy for you next. And the narrow breadth in stocks looks untenable. That is the view of Aberdeen's James Attey. More on that still ahead. Plus, we'll be speaking to Liz Martin, senior economist at HSBC. Lots to discuss in terms of the UK construction sector, the European inflation expectations, and rate hikes still to come. This is Bloomberg.
investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Today, following the worst ever year on record, bonds are back. Bloomberg is live from PIMCO headquarters in Newport Beach, California, sitting down for exclusive interviews with CEO Manny Roman, income fund manager Dan Iveson, and more as the biggest names in fixed income reveal their bond market forecasts. It's a special episode of Bloomberg, The Open, with Jonathan Farrow at 9 a.m. Eastern, only on Bloomberg Television.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. The top of Prime Minister Giorgia Meloni's Italy First agenda is the creation of national champions in areas from energy to fashion and luxury, and the launch of a sovereign wealth fund to finance them all. For more on today's Bloomberg's Big Take, let's bring in Alessandra Migliaccio, who co-wrote the story. Alessandra, when I think Italy, I don't immediately think big corporate hub, and yet that's exactly what the Prime Minister seems to be shooting for here. How is that actually unfolding, given Italy's ties to Russia?
Well, you have a very good point, and it is what she's shooting for. She's a nationalist. She's shooting for national champions. And, I mean, you're right. It's not what you think about, but Italy is a G7 country. It has a very big economy. And actually, did you know the biggest export is manufacturing and metal parts? It is not, food and wine and what you may think. So she's shooting for national champions. She thinks that exactly Italy has the wrong image. More could be done. Examples. E&I is a state-run company that she has put her people into. E&I is one of the world's biggest oil companies. Then you have Enel. Enel is a very, very big company, has huge assets in Latin America there as well. It's partly state-run, and she's putting her people in. So she's doing that just for a number of companies, and she's also fortunate because, it comes up every 3 years, and she was elected just when the nominations came up. That means that even if this government should fall, which, as you know, in Italy sometimes happens, her people will remain. So her vision can go on for several years, and that's really her goal.
Okay, so she's looking to reshape corporate Italy. Good morning, Alessandra. What do investors think of this? Because there had been concern amongst the investor community that she came from a far-right and populist politics, but has she shaped up to be what investors were expecting?
Well, from the investor's point of view, she has, because what she's doing is she's playing this very fine game, whereas internally she's still the populist, she's still anti-immigrant, she's still, not for LGBTQ rights. There's still a lot of that. But outside, as far as the economy is concerned, she's very moderate. You have the spread between Italian and German bonds that is really very narrow compared to the past. It's much lower than it was last year. It's well below 200 basis points. So that's a sign that investors have seen that she's being careful on the deficit. She's being careful about debt. She's not spending wildly. And she is, pushing this nationalist vision, but with a moderate stance. She's being careful, especially not to alienate her allies, which is key.
And speaking of not alienating her allies, one of those key allies is China at the end of the day. Talk to us about Italy's involvement with the Belt and Road Initiative. How's that worked in the past? Where might it go in the future?
Well, right, here's the thing. So it's an ally, it's an important ally because Italy is one of the few countries who actually signed this Belt and Road. But then at the same time now, Meloni wants to be a team player with her other peers in Europe and especially with the US. She wants to befriend the US. I mean, she has, but she wants to keep that going. So now she has to move away from China. She's hinted it, her ministers have more than hinted it, and she's moving away from this Belt and Road deal. What does that mean? Well, it's not great news for companies, and so she's getting a lot of pressure from Italian companies because there are more than 2,000 Italian companies in China right now. Some of them are very big. Fincantieri is a huge shipbuilder. Brembo, for example, makes brakes for Ferrari. They're going to be in real trouble if China decides to retaliate because Italy is pulling out.
Alessandra, thank you very much. Alessandra Migliaccio in Rome for us. Thank you for bringing us the Big Take story. And you can find all of the Big Take stories on Bloomberg.com and by searching NI Big Take Go on the Bloomberg terminal. This is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone. Have a great evening.
Here's what I'm watching. You do not want to miss this story. Is there the kind of upside?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Now keeping up to date with news from around the world, here's the first word. Morgan Stanley is planning to move to a new office in Singapore as it looks to expand its presence in Asia. Bloomberg has learned the company is in advanced talks to take over 5 floors of towers currently under construction. A boom in private banking, family offices, and other financial services during the pandemic has bolstered demand for swanky offices in Singapore's business district. Jamie Dimon will be on Capitol Hill today. Bloomberg has learned the J.P. Morgan Chase CEO will meet privately with a group of moderate House Democrats to talk about banking and the U.S. economy. The closed-door lunch takes place as Dimon has been urged to enter the 2024 presidential race, despite his protest that he does not plan to run. The Biden administration says military interception maneuvers by Chinese ships and planes suggest a growing aggressiveness from Beijing's national security. The council spokesman John Kirby says these actions risk an accident that could result in injury. The Pentagon says a Chinese warship last week crossed in front of a U.S. Navy vessel in the Taiwan Strait at a distance of less than 150 meters.
It won't be long before somebody gets hurt. That's the concern with these unsafe and unprofessional intercepts. They can lead to misunderstandings. They can lead to miscalculations. When you have pieces of metal that size, whether it's in the air or on the sea, and they're operating that close together, it wouldn't take much.
Ukraine says Russian forces have blown up a giant dam in the country's south. The blast has unleashed a torrent of water, putting 10 villages and parts of Kherson at risk of flooding. Residents are being told to prepare to evacuate. President Vladimir Zelensky summoned an urgent meeting of Ukraine's National Security and Defense Council to discuss the attack. And devastating images coming out of Ukraine, but interesting timing here as we hear reports of a potential counteroffensive from Ukraine as well.
Yeah, absolutely. The imagery of all that floodwater certainly makes you concerned for the people who are involved, front and foremost. And here we see, for our radio audience, just showing some of those images here on screen right now. This is a humanitarian story and very much, of course, part of the war narrative. Crop prices jumped on this, though, just to add in the market's angle, even though there doesn't seem to be much threat to crops directly in the path of this water, but certainly that was the risk from a market perspective. But to your wider point, Critty, this does certainly seem to be coming at a time where everyone was braced for a spring or summer offensive, counter-insurgency coming from Ukraine. Of course, the Ukrainians have told us they won't make it necessarily very obvious when that is going to start. It won't come with a big announcement, but this uptick in violence that we are seeing in the conflict right now is that part of that insurgency, that fight back from Ukraine.
Yeah, and it's interesting what kind of international support it's gotten as well. We were just talking with our reporter over in Italy as well, talking about Giorgia Meloni and her stance, and simply her unwavering support on the Ukrainian story has actually lent her quite a bit of political capital from around the world. And it feels like as we talk about this counteroffensive, it's really seeping more and more into the conversation in Europe, in the United States, even in Asia, about where you stand and how that dictates the future of international relations as well. One of the key stories that caught my eye over the last few weeks, Anna, is this multi-billion-dollar plan out of Europe to continue the financing of Ukraine. So certainly something to watch on that front.
Absolutely. We'll be back to the macro themes shortly. Coming up, we'll talk to Aberdeen's James Athey on why he doesn't see a soft landing narrative dying so easily. In fact, he's talking about narrative tennis, just a nice way to encapsulate those looking at forward-looking indicators, those looking at backward-looking data, and thinking about how the stances of those two camps play out from here. More on the macro themes shortly. This is Bloomberg.
politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power, the
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Lyons.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The RBA surprises markets with a 25 basis point hike and says more tightening may be needed. The Aussie dollar jumps. And Apple unveils its long-awaited mixed reality headset, but investors are skeptical of the eye-watering price tag. And the SEC sues Binance and CEO Changpeng Zhao for allegedly breaking securities rules. The crypto exchange calls the complaint disappointing and misguided. I'm Krita Gupta in New York with Anna Edwards in London. Anna, even though we have all of these kind of pieces of news on the micro front, the macro still seems to be around two words: inflation and recession.
Yeah, absolutely. And people's expectations around those two things moving around a little bit. Certainly when we saw that data, the weakness of that services ISM data coming out of the US certainly gave people a lot to think about after the strength of the data on Friday, certainly on the job creation side. This is the picture for European stocks, then pretty flat to negative on European stocks and not going anywhere very fast. Healthcare, one sector that's moving higher, but to the downside, we see the heavily weighted energy names under pressure as a result of a bit of weakness coming through in the oil price. Just what kind of floor have the Saudis put underneath Brent? We'll certainly continue to ask those questions. This is the natural gas price, and we put this in because it was up by more than 20% yesterday. This is the benchmark that we showed often at the start of the invasion of Ukraine, and it was where we were seeing a lot of the concern about gas supply in Europe being reflected. Yesterday, we saw that big jump for similar reasons, talking about issues around tightness in the market and whether LNG was going to be incentivized to go to Asia instead of staying here in Europe. It might be summer now, but of course, thoughts in that market always turning to the next winter. So we are seeing some pullback, but from elevated levels on the gas price. The pound is at 124.09, down by 0.2%. Interesting construction story developing here. The PMI for that particular part of the economy flattered by some civil engineering projects. But on the house building side, Chrissy, the lowest level of construction we're seeing since 2009. Of course, if you exclude, the pandemic, that crucially also saw weakness in the construction space. And the euro is just down 0.1% or so, just under the 107 mark. Are we expecting another couple of interest rate hikes from the ECB? We heard from Christine Lagarde yesterday. She was talking about how the inflation struggle is still on, it's still active here in Europe. So that seems to be the market's expectation after hearing from her. But we are mindful of inflation expectations more broadly from the European people, and we are seeing some downward pressure there, although that is a very volatile set of data. Chrissy, what do you see in the US?
Yeah, well, that downward pressure, that flat to negative sentiment that you were just outlining, Anna, certainly fueling perhaps the equities a little bit to the downside, although not really having that major conviction or sell-off kind of tone just yet. All of that could change in just a few hours. Futures trading about 42.77 on the contract here, down about 0.1%. We'll call it that for our radio audience. The two-year yield, though, to me is what's more interesting, because as we see the kind of Fed get repriced, the idea of whether they need to go hard on inflation coming off those really hot payrolls numbers, or perhaps take a step back and perhaps hit that pause button with the market is pricing in off again the ISM data you mentioned, Anna. That kind of tug of war between the narratives is really hitting the two-year yield, kind of going back and forth, re-entering that trading range. 444 on that, although down about 2 basis points. So seeing a little bit of a bid into the front end of the curve. As the yields come down, though, the dollar follows. So that bias that you were seeing, that weakness perhaps reflected in the greenback as well. But nothing I would really write home about just yet, because again, everything could change at those opening bells. NYMEX crude is what's interesting to me, though, because as we talk about inflation, it's the recession fears that are kind of creeping into the market. You really see that show up in the commodity space. A 70 handle on NYMEX crude, already down 2%.
Okay, let's get into a markets conversation then, Critty. We're joined by James Assey, Investment Director at Aberdeen. James, very nice to have you with us today on Bloomberg TV. Let me start by asking about what you call narrative tennis. So the idea that we've got a couple of different competing narratives, at least 2, in the market. Maybe there are other balls on the court as well. But how do you find that this is resolved? In which direction do you think we resolve this?
As you say, big picture, there are 2 narratives, but when you scratch beneath the surface, that there are definitely more. I mean, a sort of popular and very simplistic macro framework is a kind of quadrant approach, and you've got growth on one axis and inflation on the other, and whether growth is high and rising or sort of decelerating, and inflation likewise tells you something about the likely environment for macro investing. I reckon in the last 6 months, we've spent time in each of those quadrants. You know, stagflation, recession or no recession, inflation or deflation. And the data really has been volatile and inconsistent enough to support each of those narratives at a certain stage. And then globally and regionally, we've seen likewise, you know, Europe and UK expected to have severe recessions because of energy prices flipping around and suddenly then becoming the sort of pro-cyclical investment of choice. And more recently, because China has slowed, Germany seems to be in technical recession. We've gone back again. Realistically, taking a big step back and trying to look at this from the highest level possible, it still appears to me everywhere that the data is trending down with a lot of volatility, but trending down. And the most recent data we had out of the US service sector really didn't look great, considering that has carried the bulk of the burden in recent months for growth generation. So my base case is still that the monetary tightening into a highly levered system that we have seen is ultimately taking us towards recession.
Okay, so that's the interest rates and what they're doing. But thinking of this like a tennis game, I mean, it almost seems as if we got to match point and then have to wait to play that point another time. In yesterday's session, where we saw the S&P nearly into bull market territory then, James. What are your thoughts on whether this really is going to be a bull market, or where stocks more broadly here? Morgan Stanley suggesting that the narrowness of this rally means, driven by moves in the dollar and the AI frenzy, the narrowness of this rally means that this isn't really what bull markets are made of.
No, exactly. I think a lot of people have observed and made that comment that normally when you start a new bull market, A, leadership changes, and B, it broadens. What we've seen here is basically the same very narrow set of mega cap tech stocks leading this bounce in the same way that they led the prior bull market. That's unusual. I think it's fair to say lots of things we're seeing are unusual and historically unprecedented or without precedent for quite some time. So it's difficult for me to say it can't be true. Ultimately, though, again, I think if recession is the likely outcome, it would be highly unlikely that we would start a new bull market while the Fed was still tightening policy, and indeed where 5 stocks basically do all of the work. All of that tells me that this is still a bear market rally, a painful one for bears and shorts. But ultimately, the economic outturns will dictate where the broad indices head next. And I think as we move into the second half, that's going to be lower.
But James, let me push back on that idea, though. Why is leadership by a handful of stocks, similar to the leadership we saw in the last bull market, such a bad thing, given that the last bull market lasted 10 years or so and has significantly contributed to portfolios around the world, given that this time there's actual real money behind cloud, AI infrastructure, things that have really been accelerated by the pandemic. Why is it a bad thing to have such concentrated gains, given perhaps it's justified by the fundamentals?
Sure, yeah. I mean, it's not to say it's good or bad, Kriti. It is just to say that historically it's anomalous. We don't tend to see a sort of new bear market beginning with such narrow leadership, which is identical almost to the prior bull market. Again, that's not to say it can't happen, but when it comes to the fundamentals, I think one of the things that's been easily jettisoned over the last several years, largely because central banks have changed the nature of the game, is that investing is ultimately about value. It's not about just making a call on where earnings, where the economy are headed, but it's understanding what's discounted by the markets and investing on the basis of where there is value in doing so. And I think Amazon, a company which has been around for 3 decades, is highly mature and has seen rapid earnings growth from its non-core business, which is to say retail really doesn't make money now, and AWS has been an earnings machine. For it to be trading off a price earnings ratio of 114 suggests to me that maybe investors at this stage are overpaying for what is a high quality company. The examples that people always give, and I think they are highly valid, are things like Cisco and Sun Microsystems. You go back to 1999-2000, and they were priced for the sort of growth that they could not on balance achieve, certainly not while still seeing appreciation in their share price. And if you go back over that period, Cisco's annualized return is something around 0 to -1%. It's not a bad company. It wasn't a bad company. The narrative was absolutely correct, but the value just wasn't there as an investment.
It's an interesting point to make at a time when valuations in general are kind of being questioned as whether or not they should even be a factor. I want to bring to you a quote here from some of the strategists over at Citi, talking about kind of what you're talking about, perhaps with the opposite argument. With further support, they write, from the first quarter 2023 earnings and the uncertain macro environment, we believe the rotation from value to growth may continue. The potential Fed rate skip this month and cautious relative positioning in the equity market are tailwinds to growth performance as well. They're talking about that rotation to growth kind of coming in this environment of decelerating economic growth specifically. But are you the opposite for us here, James? Talk to us about the tailwinds in the value trade.
I mean, fundamentally, no, I'm not the opposite. I sort of understand the point that they're making, essentially, is that growth stocks have been seen as defensive in the sense that they've behaved a bit like duration because they've got this long profile of rising earnings revenue. The discount factor tends to be a bigger driver of current share price performance. So in an environment of falling yields, they should perform better than less sort of duration sensitive stocks, but also because recent history has said that a lot of these companies have been able to generate solid earnings growth almost regardless of economic outcomes. So if we are headed into a period of rocky economic performance, potentially disinflation, lower yields, lower Fed policy rates, all of that looks like a tailwind for growth. My hesitation is that, again, they are incredibly expensive. I would argue that they have already discounted a lot of the positives there, but they haven't really discounted a genuine economic recession. And I think some of these companies may see their earnings, their revenues being a bit more cyclically sensitive than is being priced. But this market has proven that momentum is such a powerful driver that trying to express that in the short term, can be a losing strategy. On the value side, it's more cyclical, but it's cheaper.
James, I just wonder if we are due a pullback in tech names then, I wonder how severe that becomes. I talked to Newton Investment Management earlier on, and they were asking themselves whether this is like 1999, and you alluded to that period earlier, and we all know what happened straight after that with the excitement over the dot-com boom. But they also wonder whether it could be 1994, and we're more at the foothills of the excitement. What are your thoughts?
I mean, I certainly hope it's not 1994 from a bond market perspective, because the Fed policy changes in 94 led to some serious losses. And I'm sure the Mexicans hope it's not 1994 because that really ended with them having the tequila crisis. Yeah, historical analogs by their very definition are a bit tricksy. I do think there are a lot of parallels to 1999, but I don't think the extreme of valuation broadly is quite as bad. But I think the leadership is much more narrow. But it's in businesses that I think we understand better, that are less speculative in terms of the nature of those businesses. So I'm not sure there's an exact parallel between either of those two historical analogs. Again, apologies for sort of being highly repetitive here, but I'm just going to fall back on the economics of the situation, and I think that will ultimately dictate whether I am right or whether I am wrong. If the economy avoids recession, if we manage to find some sort of equilibrium, stable equilibrium with low unemployment, and we can generate growth from these new productivity enhancing businesses, even if that growth, by the way, is not particularly well shared socially, then potentially the equity market is not going to go anywhere near those lows from October last year. Again, I would be shocked if economies manage to avoid recessions, given the sort of wealth of headwinds that they continue to face.
Yes. Okay, James, really good to get your thoughts. Aberdeen's James Athey, thanks very much for joining us. Coming up on the programme, we'll get back to some other macro themes across Europe. Liz Martins joins us, senior economist at HSBC. That conversation next. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Moment news breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
Price pressures overall remain strong. Inflation, excluding energy and food that I have just mentioned, declined to 5.3% in May from 5.6% in April. That's what we call core inflation. Upside pressures on both headline and core inflation are still coming from the pass-through of past energy costs increases and supply bottlenecks.
ECB President Christine Lagarde, of course, reiterating yesterday that rates will rise further to regain control of prices. Let's talk about the European economy then. Liz Martins joins us, senior economist at HSBC. And Liz, in terms of the ECB, did we just cement expectations then on hearing those words from Christine Lagarde that we will get further hikes from the ECB and one of those will come next week?
Yeah, I think so. I mean, obviously, there was some welcome downside news in European inflation in the numbers that we got last week. Not universally, but for most of the major markets. But clearly, nobody came to the conclusion that inflation is dead in Europe. Actually, that number she mentioned, 5.3% core inflation, is still well above the comfort zone. So we do think that, yes, they hike next week, 25 basis points. I think that's quite consensus, according to the markets and economists. But also, we think they do it at least one more time afterwards and probably twice.
A month or so ago, we got German factory orders that fell by 10%. Bit of a shock to markets, much worse than expected. Today, we got a number that wasn't as big a miss to the downside, but it's certainly still in negative territory, Liz, for Germany. This a reminder, though, that as the challenges around energy continue in some places, there are still parts of the industrial complex in Europe that are up against it.
Absolutely, and I think the manufacturing sector in particular, you know, you look around Europe and globally as well, there's some real evidence of pressure here. I think probably when economists put in their forecasts for this industrial orders number for Germany, they probably thought, well, you know, we can assume there'll be a little bit of a rebound, 2-3%, and we didn't even get that. We got a further fallback, so really quite a downbeat release. But I think, you know, there's a few things going on with manufacturing globally. One is on the consumer goods side. Of course, consumers seem to have rotated their demand away from goods, the physical things that we buy in the shops and which people manufacture, and towards services, experiences, going out, having fun. That's a post-pandemic trend that shows no sign of slowing up. But the other thing is, of course, manufacturers don't just make consumer goods, they also make investment goods. And that maybe, I think, is starting to get hit by higher interest rates. So for a big manufacturing economy like Germany, yeah, of course, that's going to hurt.
Well, between the kind of COVID hangover that we have, and of course the war in Ukraine as well, it's no secret that monetary policy is extremely challenging, and it feels like kind of inventing a new roadmap as we go. Liz, talk to us a little bit about the decision we got out of Australia overnight. Is there some sort of lesson that can be learned from Australia for the ECB, for the BOE, or more specifically, the Federal Reserve stateside?
Yeah, I think all these central banks that you mention are in the exact same quandary, aren't they? They'd love to be able to stop raising interest rates. They see economies slowing. They see labour markets starting to turn. But unfortunately, when they look at the core inflation data and the wage data, and particularly in Australia, we had a big hike, I think, in the minimum wage, which unsettled the forecasters over there in Australia, and that meant they just didn't feel they were able to stop tightening policy. So I think that, you know, the decision in Australia, of course, to hike by 25 basis points, it wasn't a huge surprise. I mean, we thought this was a very, very finely balanced meeting, but certainly it shows that as much as central banks would love to be able to stop tightening, broadly speaking, the data aren't allowing them to do so.
Liz, thanks very much. Thanks for joining us. Liz Martins of HSBC with some reflections on the global economy. And thinking of global economic forces, later today, Bloomberg's Jonathan Ferro hosts The Open, live from PIMCO's headquarters in Newport Beach, California, of course. He'll have exclusive conversations with the PIMCO CEO, Manny Roman, CIO, Dan Iveson, Global Economic Advisor, Richard Clariter, and other top executives. That is today at 9 a.m. Eastern Time. This is Bloomberg.
is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Let's take a quick look at some of the stocks we're watching in pre-market trading stateside. Anna, top of everyone's mind seems to be the Apple story. We, of course, know that they released their new headset with a pretty hefty price tag. Those shares down about 0.6%. And Anna, I always wonder with Apple, who is their main competitor? They kind of dabble in a little bit of everything, but who are they really competing with?
Yeah, and a lot of focus on who are they really selling to in this particular case. If you're thinking of Vision Pro, as we were hearing from our colleague Alex Webb at the top of the program, a lot of focus on that price tag and the name Pro, and does that suggest it goes to a business audience, not quite so mass market? So that's an interesting one to reflect on. We're also focused on other tech themes today, not least of which the tech names that could be influenced by TSMC and the amount of capex it's going to do.
Yeah, it's interesting when we talk about just kind of this supply chain shortage turned a weakness, essentially. The idea here simply being that 2 years ago, there was a major kind of demand for supply chains. Now there seems to be a big glut of chips in particular. So Taiwan Semiconductor Manufacturing Company, TSMC, trading out of TSM, by the way, the ADRs stateside higher by 0.2% as they talk about cutting back. Efficiency is a really key part of that story. What's interesting, though, is it's not having the ripple effect into other chip names like NVIDIA, like AMD, or even like Intel, for example, which again is interesting as Apple specifically. I'm going to connect it back to our previous story, Anna. Apple talking about making their in-house chips, something that again eliminates one of the major customers for the likes of Intel, NVIDIA, AMD, and of course TSMC.
Yeah, we have some negative movers on the technology space here, the likes of STMicro and Infineon, but not falling by a huge amount. Well, STMicro down by 1.6%. Also under pressure, though, in Europe, Chrissy. Certainly some of the energy names. This is by far and away the worst performing sector in Europe today. Energy stocks down by 1.5%. We have a big move downwards in expectations for oil companies as we get towards the start of trade in the US.
Exactly, and the spread, by the way, between Brent and NYMEX is certainly something to watch about. 70.81 stateside here, Anna. We're talking about it really testing that key 70 level. The read-through, though, when you see that weakness into NYMEX crude is simply more weakness in a lot of those names that are extra exposed to stateside production. I'm talking about Marathon Oil, Apache, Halliburton, all down to the tune of anywhere between 2.8% to 3.6%, that kind of range. And it really speaks to the idea that these are your three worst performers in the pre-market. So that energy weakness you're seeing in Europe, Anna, likely to kind of flood into the U.S. as we get into the opening bells.
Yeah, absolutely. A lot of focus then on energy stocks, focus on technology. Could we get in any of the sessions soon to a bull market, technically defined perhaps, up 20%, of course, on the S&P. That was the conversation yesterday, but we didn't manage to get there. We have to play that one on another occasion, perhaps. Or is this not really a bull market? That's the view of Morgan Stanley. They said the narrowness of this, and we heard from James Athey over at Aberdeen. He was agreeing the narrowness of this does not make it to seem like a classic bull market. That is it for Early Edition. Surveillance is ahead. Wells Fargo's Anna Han amongst the guests on the program. This is Bloomberg.
Forget a degree in finance. Go for a career in tech instead. That's the advice from the latest Bloomberg survey of professional and retail investors. Only 1 in 5 Wall Street professionals say high school seniors graduating this year should follow their footsteps and go into finance. About half say that Gen Z's best bet actually lies in the tech sector, and that's despite all those recent layoffs at companies like Meta, Amazon, and Google. Still, hiring trends paint a rosy picture for those with a background in tech. Industries ranging from auto to the federal government have jumped at the chance to recruit any laid-off tech workers. A degree in tech could set you up for a lot of potential jobs and a safety net if any of those jobs don't quite pan out the way that you'd hoped. Survey respondents also expressed concern about the long-term threat of AI. Think ChatGPT taking all of our jobs. For kids graduating from kindergarten this year, about 40% of investors said to go into healthcare. That way, when they come of age, they may be able to hedge against any potential AI-related job takeovers. Roughly 12% said Wall Street would be the right career given that pending AI threat. The AI concerns come despite traders themselves finding that current iterations of ChatGPT struggle with things like math and corporate earnings. But the idea here is that there's still plenty of time for AI to improve and to potentially threaten our jobs along the way.
This is Bloomberg.
Markets, after they've run this much, they're always fragile, right? So you're looking for the next shoe to drop.
I do think the Fed is driving us towards a stall speed in this economy. And when you're at a stall speed, you become unstable.
The Fed is behind us. Maybe they hike once more, maybe they hike twice more, but that's it.
I think the Fed being on hold just should not be confused with job done.
The soft landing can't be ruled out. I don't think it's ever been able to been ruled out entirely.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Day 2 of waiting for a bull market. Good morning. Welcome back. Well, this is Bloomberg Surveillance from New York City. John is supposedly working in California on a beach somewhere. Tom is officially on vacation. You're looking out for day 2. You have me again. You also have Julian Emanuel, Chief Equity Derivatives and Quant Strategist at Evercore ISI for the hour. And this comes at a time when we are seeing this 20% potential gain on the S&P since the lows that we saw in October. Is this rally real?
We think it is, actually. We don't want to put the label bull market on it, okay? Because frankly, our base case is that sometime in the next 12 to 18 months, you're going to have a recession, which means you're going to have a sizable pullback. But this is a cyclical rally where we think the hallmark of the last week or so is a broadening of participation.
Well, what is it about the labels? You don't want to call it a bull market. You don't want to call it a pause. You want to call it a skip. Like, why does it matter?
Well, it matters a lot. If you go back to the 2002 tech bubble burst bear market, you had several rallies of 40 and 50% in the NASDAQ before you made the final bottom. It is one of those things where rather than labeling, you have to think about how you want to
escalating war there, or if it's ratcheting up of tensions in China, between the U.S. and China. How much are you looking at potential tail risks, or do you think that that's what's dampened some of the valuations at this point that sort of set up for what you're talking about?
It's definitely dampened the valuations, and this, again, the period we believe we're entering is one of those times where despite those risks, we do think we're going to see a little bit of multiple expansion, which is a bit counterintuitive. But frankly, what it does, and again, going back to our options expertise, the VIX with a 14 handle is absolutely fabulous in terms of protecting either downside risk or, for some who are underperforming and may get pulled into a chase, upside risks.
So we're kind of bearing the lead here. On Sunday, you made a pretty big move. You upgraded, you increased your expectation for the S&P to 4450, and potentially you might see that as soon as July. Explain.
That's the hallmark of a momentum market. And I think, look, clearly the NASDAQ has been in a momentum market essentially since the end of March. And for us, the last week or so is encouraging because the S&P broadly has joined with that in its clear move above the 4,200 level, which had been basically 6 or 7 months versus of resistance. We're actually starting to see a little bit of broadening into the small caps, which is very encouraging. But frankly, again, this is an environment where the momentum takes on a life of its own. And that's also a function of the fact that if you look at it, sentiment, whether you're measuring it in terms of the stock market or the economy, or again, thinking about risk, is incredibly, incredibly poor. And yet at the same time, we're seeing data that says there's a chance that this recession gets pushed out. It keeps getting pushed out. It may end up getting pushed out to 24.
And right now we're seeing basically a range-bound market ahead of yet another day of quiet period for the Federal Reserve, but anything but when it comes to some of the international fluctuations. You see about a 0.1% decline on the S&P 4275, still on the 4,300 watch. We didn't quite get there. Ongoing weakness over in the euro, but it's basically been around 106.8 for quite a while with a bit of a stronger dollar. And 10-year yields lower just a touch after those ISM services data that came out yesterday. Kind of disappointing, even though still in expansion. Crude a little bit off earlier lows. I want to note, I said John's on the beach. He's actually in Newport Beach. He's hosting the Open from PIMCO's headquarters, which is the reason why he ditched me, along with Tom. He'll be speaking with CEO Emmanuel Roman, CIO Dan Ivison, and former Fed Vice Chair Rich Clarida, who's their head economic consultant there at PIMCO. That's all coming up today, starting at 9 a.m. Eastern. Today, annual shareholder meetings will happen for Zillow, Urban Outfitters, Palantir, and Freeport-McMoRan. I say this because we actually saw some really interesting guidance out of Taiwan Semiconductor Manufacturing Company, basically downwardly revising some of their expectations. You're seeing shares off today. So it's sort of interesting to see some of the commentary coming out of these meetings at a time of such fluctuation. And today, I know that you love talking politics, Julian, so I really wanted to get you on this. Former New Jersey Governor Chris Christie is expected to jump into the race to become Republican candidate for president. He has been called in one New York Times article the Trump Slayer, people saying he has no chance to win, but his complete objective is to act as an attack dog on the stage in debates with the former President Trump. A pretty crowded field in the Republican race, potentially 12 candidates by July.
Well, you do wonder if Governor Christie is going to announce with a pair of Everlast boxing gloves on his hands.
Essentially, yes.
No question about it. Look, this is healthy. At least I think you can call it healthy. Let's see what happens. My question is, and hopefully we'll have someone help us answer it, is, who among the field, aside from Trump and DeSantis, could potentially rise to sort of create a three-way race? That's the big question.
And a lot of people are looking down to Virginia potentially for that, and we will get into that later. I do want to get to what we heard over in China, a recommendation that state-owned banks start to reduce their deposit rates to encourage lending and to increase their margins. Joining us now is Bloomberg's Tom McKenzie, who covered China for more than a decade. He's in London. Tom, what do you make of this? And also, what do you make of the fact that it's not a mandate, it's a recommendation?
Yeah, there's a fine line between a mandate and a recommendation when it comes to official policies out of Beijing when they lean on those state banks, of course. But it builds on what we were talking about last week, Lisa, around the measures being put in place, at least the proposals being discussed, according to Bloomberg reporting, to kind of shore up the real estate market. Now you have more piecemeal efforts to try and put a floor under the growth that has come through from China, less strong, of course, than many had expected. So leaning on the banks to reduce those deposit rates, it means that the banks can then look to lower the loan rates and provide more liquidity. We did see loans, new yuan loans, that credit impulse came through in the first quarter, but then it dropped on April. And clearly there was concern about the fact that there wasn't that traction going forward in terms of liquidity and that demand for loans. Households, businesses, they're shoring up their balance sheets. Households are paying down their mortgages. The question really is there the demand, even as it becomes easier to take out a loan and to access that liquidity, is there really the demand to kind of tap into that and then support the economy?
On one hand, this is kind of stimulus light, and that's positive potentially for growth. On the other hand, this indicates that perhaps the Chinese Communist Party sees a bigger problem than they're letting on. Which is it?
Well, it's interesting. I was speaking to Hao Hong, who was formerly of BOCOM, a really respected strategist there, and he said, look, this seems to me like a government that's running out of ideas. Bloomberg Economics, they now view the chances of a benchmark rate cut, so for the 1-year and the 5-year medium-term lending facilities, they expect those to be reduced possibly as early as the middle of June, but there's a debate about that. Jones Lang LaSalle, economists there, say they actually think this action to lean on the banks to reduce deposit rates and therefore give them the scope to reduce loan rates, that probably pushes back a benchmark rate cut for the PBOC. By the way, for the context, they've cut just 50 basis points, just 0.5% since the start of the pandemic in 2020. So they do have that dry powder, but again, they have this massive debt pile, and there's that concern, of course, in terms of just adding to that if they go with a broad benchmark cut. But it's certainly something that now the Bloomberg economics team thinks is possibly likely mid-June.
Tom McKenzie, thank you so much, of Bloomberg, joining us from London. Julian Emanuel of Evercore ISI here with me for the hour. What do you make of what's going on in China and the fact that the growth is sort of running out of steam to such a degree? Do you feel like a lot of that story has been priced in and is really on the wane?
So we actually think that it's the bumpy path to a more sustainable number. It's not 6% or north of 6%, but it may settle in towards 5%. The issue here is a couple of things. First off, the way that China wants and will likely grow is unlike the last 20 years. You're making the transition to a domestic consumer-led economy, and the issue is that you've had a second COVID wave over the last 5 or 6 weeks. And it's hard to say, I think, right now, just how much of a dampening effect that has. But, in hearing the suggestion that banks reduce their rates, I'm reminded of that phrase, moral suasion, that I suspect you'll get a degree greater of moral suasion if things don't pick up. And obviously, the government is very, very in tune with the pulse.
The beatings will continue until morale improves, a bit of that. I mean, there is this question, though, going forward about how much of a tailwind or a headwind China will be. And as you talk about upgrading your forecast for U.S. equities, do you see U.S. as sort of being, I don't want to say a haven, but a new sort of spot of focus after everyone was looking international for the first half of the year?
Well, again, it is a mixed bag, because if you look at some of the consumer-focused names selling into China, they have sold off in the last month, even as the rest of the market has stabilized, and obviously parts of it have rallied quite strongly. And that tells you that it is an open question. The one thing that does seem clear is that this whole idea that China is going to be this very discrete reason for inflation to take another leg higher, that we don't subscribe to.
Every morning in your morning meetings, what do they seem like? Do people kind of sit around and they're like, well, it's the same kind of waiting game. We're not sure, but today we see more gains. I mean, is it sort of a momentum kind of discussion?
Well, it is, but, and again, when you think about it, Ed Hyman has been absolutely on the forefront of the view that inflation is going to come in faster than people expect. Now, the last month or two, it's been a little bit choppier, and we look ahead to next week, we think that's likely to be a sign.
We certainly saw that from the ECB and their consumer inflation release that they put out today, saying that expectations fell considerably. So how much do we get that with the CPI report coming out on Tuesday ahead of the Fed meeting on Wednesday, where they're expected to pause, skip, and then possibly do something later? We'll talk about that coming up at 7 a.m. as well with Greg Peters, co-CIO of PGIM Fixed Income. Julian Emanuel sticking with us. We are so glad to say.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Ukraine says Russian forces have blown up a giant dam in the country's south. Now, that blast has unleashed a deluge of water, putting 10 villages and parts of Kherson at risk of flooding. Residents are being told to prepare to evacuate. President Volodymyr Zelensky summoned an urgent meeting of Ukraine's National Security and Defense Council to discuss the attack. In France, unions are holding a fresh day of strikes against Emmanuel Macron's pension reform. It's the first nationwide protest in more than a month, and it will test whether the president has succeeded in getting much of the country to move on from the politically damaging fight.
Macron has faced down months of protests and strikes. He angered many when he enacted the legislation without a full vote in Parliament. Consumer expectations for Eurozone inflation eased significantly in April, giving the European Central Bank reason to end its run of interest rate hikes this summer. According to its monthly survey, expectations for the next 12 months fell to 4.1% from 5% in March, and for the 3 years ahead, they slid to 2.5% from 2.9%. Jamie Dimon will be on Capitol Hill today. Bloomberg has learned the J.P. Morgan Chase CEO will meet privately with a group of moderate House Democrats to talk about banking and the U.S. economy. The closed-door lunch takes place as Dimon has been urged to enter the 2024 presidential race, despite his protests that he does not plan to run. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ. Today, following the worst ever year on record, bonds are back. Bloomberg is live from PIMCO headquarters in Newport Beach, California, sitting down for exclusive interviews with CEO Manny Roman, income fund manager Dan Iverson, and more as the biggest names in fixed income reveal their bond market forecasts. It's a special episode of Bloomberg The Open with Jonathan Farrow at 9 a.m. Eastern, only on Bloomberg Television.
Ultimately, this is going to be about a choice. And so it's as much about Joe Biden as it is who Republicans choose and or if there's a third-party candidate. So the 2024 election is going to be a big wild card for the market for the rest of this year and especially, obviously, next year.
That was Ed Mills, Raymond James, Washington policy analyst yesterday, talking about what we have ahead of us for more than a year of excitement as we gear up for the 2024 elections. The candidate pool for the Republicans has gotten pretty big. It is getting bigger. We have heard from, of course, the former vice president. We also have, of course, potentially get Chris Christie today saying that he is going to enter the race. I'm Lisa Abramowitz. I'm not here with John. I'm not here with Tom. John is off. He will be here at 9 a.m. or rather in Newport Beach. But I'm so lucky to say, even better, we have Julian Emanuel stepping in for the hour to join us. And I have to say, we got over the debt ceiling drama. How much are you really turning your focus already to the political sphere ahead of next year's election?
Well, it's certainly interesting to conjecture, but again, as even the most devoted political followers will say, it is a long time, A, till Iowa, and B, till the general. So much can happen. It's definitely a consideration, but in terms of moving the markets, very little at this point.
Well, it certainly moves the news airwaves. And I will say New Jersey Governor Chris Christie, former New Jersey governor, is likely to enter the race today. And then the wild card is whether Virginia Governor Glenn Youngkin joins the fray over the next couple of weeks, which is what PIMCO is actually looking for. And that would bring the total pool to potentially 12 by July. Joining us now, Terry Haynes, founder of Pangea Policy. Terry, do you think that it's going to come to that by July we will have 12 Republican candidates duking it out to try to get the upper hand from the former President Trump?
Oh, I think so. Why not? You know, the more the merrier. What people have reverted to in the Republican field is the idea that, you know, there's career advancement involved, that you can advance your career more quickly by joining the field than by staying out of it. And, you know, secondly, there's a why not me aspect to this, where, what a lot of people sense here, a lot of these candidates sense, is that they're going to be, the electorate's going to be hungry for alternatives as Trump continues to be weighed down. And so there's a good opportunity for them. So in a sense, the field is kind of looser and more entrepreneurial than it has been for quite a while.
There was a New York Times article yesterday about the Trump Slayer. That was what they were calling Chris Christie, that his job was not to get elected because he had no chance to win, but that he would come out with, as we just heard from Julian, boxing gloves on, and he would go on stage.
The big difference between 2016 and 2024 is going to be that the vast majority of these candidates come in honed to take Trump down. So there's a possibility here that there might be kind of a pack swarm mentality that helps let the air out of the Trump balloon.
So, Terry, let's sort of just step back for a second. Obviously, you've got Trump as the very clear front runner right now, and then Governor DeSantis as the rather clear second place. Who amongst the rest of the field, it's almost like a Kentucky Derby bet where you're betting the field, who among the field is likely to emerge, call it by Labor Day, as the potential challenger to those two?
Well, I don't think it's going to emerge necessarily by Labor Day, but the two that I would suggest folks look at are former Governor Haley of South Carolina and Senator Scott of South Carolina. Haley's making a very good and interesting pitch, by the way, I think, to those who want less partisanship, but people to move forward in Washington. She's offering that alternative with a good deal of specifics. It's a refreshing change of pace in just terms of how she talks about it. Senator Scott is the classic feel-good story of this field. He's very articulate. He is a worker in the Senate and very conversant with policy of all kinds. And, both of those, I think, are going to distinguish themselves.
Meanwhile, we're talking about the potential, in particular, Speaker Kevin McCarthy.
Just on it, but I think right now what you've got is right after the debt ceiling, by the way, which I think is important. What you've got is a situation here where what Speaker McCarthy is talking about is, hey, we just negotiated spending deals. I'm not going to deal with this by just blowing up the deal in some sort of a supplemental. I'm going to wait and see what they actually need, and we're going to address this as part of our regular process in the fall and into the winter, whereas you've got a lot of Republicans in the Senate, people like Lindsey Graham, for example, who are saying, no, they need the aid now. What's going on underneath that, by the way, is that if the Ukrainian counteroffensive doesn't succeed completely, but it succeeds at least in part, what you're going to get coming in 2024 is a lot of Western ally pressure to settle this thing through negotiations. And you see on the other side, China already trying to make these moves by re-enlisting Macron. So this is going to be the summer that tells the tale for Ukraine. And Speaker McCarthy doesn't really have to make a decision soon, so he's trying not to.
Terry Haynes of Pangea Policy, thank you so much. Julian, I have to say, as we talk about all of these issues and the presidential candidacy and the sort of growing field, there are reports that JP Morgan CEO Jamie Dimon is heading down to Washington today to meet privately with a group of moderate House Democrats to the U.S. economy, banking, et cetera. Is he running?
Probably not. Okay, to me, the scenario where he runs is if, let's say, President Trump clears the field and then his legal woes overtake him next year as sort of a potential substitute. But I don't think so. I think that, Jamie Dimon is among the world's foremost bankers of all time and is likely, very best positioned to continue rendering financial advice in that context.
How do you feature some of the sort of tit for tat that you don't necessarily have as market moving, but sort of the policy implications of that? How do you factor that into models that are already about as cloudy as they've ever been?
Well, look, we know that for one, the to issue more debt, fortunately, has to, because we fixed that, and there is a little bit of a crowding out effect. We also know that, look, as minor as it may be, we may have turned the coin on, the runaway growth in spending. We got a little bit of a concession there. And so all of those sort of factor in to this idea that there is perhaps less of an infinite boost to the government supporting the markets and the economy that there was. And frankly, in the long run, if you shift things back to the private sector, that's a good thing.
All right, so you aren't not concerned, and you're not on the concern about the T-bill issuance and all that, and the sort of liquidity sucking out. You don't seem like you seem.
No.
Yeah,
no.
Not exactly a big thing as you look for 44.50 potentially by July, upgraded from 41.50 previously, a shift on Sunday. Coming up, Pooja Sriram, U.S. economist at Barclays, as we wait for the CPI report on Tuesday. Does it show the rapid deceleration that Ed Hyman is looking for? Today, we are looking for a pretty quiet day, although possibly a new bull market. This is Bloomberg. Don't go.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
That's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning. Welcome back. This is Bloomberg Surveillance with John Farrow, Tom Keene, and Lisa Abramowitz, except it's not with John Farrow or Tom Keene today because they are both off. Actually, John is not off. He is in Newport Beach, probably waking up at the crack of dawn or not even. And we will be getting to him later. We have Julian Emanuel with us from Evercore ISI for the full hour, which we are very excited about. Right now in markets, you are seeing a bit of a range-bound feel as we sort of tread water, trying to bump up against that 4,300 test. A lot of people, not just Julian Emanuel, but also Lori Calvasini yesterday coming out and upgrading their forecasts potentially to 44.50. That from Julian. We are seeing a bit of dollar strength versus the euro, but again, that pair has been pretty much range bound. And interesting, the Russell 2000 kind of going nowhere, but still not lagging, which is interesting. Overnight, there was actually a pretty significant move from the Reserve Bank of Australia. They were expected to hold rates firm. They did not. They raised by 25 basis points to the highest level, 4%, going back to 2012. At the same time, at the same breath that Australia sees inflation reaccelerating, you see over in Europe, the ECB coming out and saying that consumer expectations of inflation have dropped quite considerably in the month of March. What's the truth? Is inflation decelerating more quickly, or is it stickier and reaccelerating in other areas? Michael McKee will give us all the answers. Bloomberg economics and policy correspondent joining us here on set. So what is it?
I wish I knew, because then I would be able to tell Julian how to bet for the Fed meeting next week.
Which is the goal.
The problem is inflation has stalled out in the U.S., and the Fed thinks it's going to start going back down again, but that's what they thought in Australia. And then inflation came back, and they felt they were forced to raise rates, and they came out with a statement that basically reads like we're going to see from the Fed that further rate adjustments may be necessary depending on how the economy evolves. So they're leaving their options open to go the other way even further. The inflation expectations numbers don't tell you as much because it's largely based on what people are seeing and that sort of thing. So those are likely to turn around as gas prices go up with Saudi Arabia cutting production. So we could see some changes there. And obviously, the final point I'd make is that inflation numbers are backward looking, but they're all that the central banks have to make their decisions, really. And so if we get a big number next week, which we're not supposed to get, according to the Bloomberg survey, then the Fed might be forced into raising rates again.
I can feel sort of the blood moving up in Julian's arms, basically, as he thinks, no, inflation is not going to surprise to the upside. It's not reaccelerating. So how do you push back against that?
Well, so I'm just curious, you know, and that in the context of we do believe that they will pause next week.
Well, it's jawboning to a certain extent, but it's can they back that up? The problem with it, for the Fed, is that the markets front run them, and some kind of inflation scare or something else that happens do not move the rates. We're going to leave people with the impression that we might in July. And certainly there's a more than 50% chance at this point that they're going to raise rates in July, according to futures trading. But an interesting question, and I asked this yesterday from people who were here, is you get the futures telling us we're going to get rate increases, and then at the end of the year we're going to get rate cuts, but then the traders, the people who are actually making these trades on everybody's desk, are saying, we believe the Fed. We think they're going to either raise rates or hold. We're not going to be cutting rates. Is the same for you?
So for us, the prospect of cuts priced in later is more of a probabilistic risk management type of situation. Our forecast is you are going to get a recession. The question is how deep, how long. If it's sort of the down 1, down 2 quarters that Ed Hyman expects, we don't think the Fed will cut, but it's probabilistically if it's deeper or if there's reverberation of the bank stress, that's it. But I think the expectation is there really won't be a cut in the near future.
And everyone seems to be pushing back some of the recession forecasts, including Pooja Sriram and the team at Barclays. They adjusted their outlook, writing, quote, they are pushing back their recession forecast to the fourth quarter of 2023 and penciling in 25 basis point hikes in July and September with a meaningful chance that one is pulled forward into June. Pooja Sriram, U.S. economist at Barclays, joining us now. So is this basically not a soft landing, but a no landing for now until later, or is this simply something else where the pain is going to be greater because of the delay in the meantime?
Hey, hi, good morning, Lisa. Yeah, great question. In fact, we revised our outlook just looking at the sheer strength of the hard data on hand. At this stage, so late in the rate hiking cycle, one would have expected monetary policy to have gained more traction. But that clearly hasn't happened. So, if you look at the length and breadth of the data, whether it's consumer spending, whether it's labor markets, hints that housing demand is beginning to firm as well. It all seems to suggest that, that slowdown that, we had penciled in might take longer to materialize. And so, we think that, there is a slowdown that will happen, but it would be later in the year. And, we're also penciling in a shallower recession now. It's about 3 quarters of very modest negative growth, in fact, pushed out into Q1 of next year. So I think it's going to be a tricky situation where we think it'll take longer for the monetary policy tightening to beginning to see some effect on demand and activity.
I hear more and more people.
So they will hopefully land.
But, this is what I keep hearing from more and more people. It seems like the soft landing scenario is coming back. And nobody really wants to say it because it's almost like, this time is different. It's sort of a natural curse the second you say it. But are you getting in that camp?
Yeah, I guess it's hard to see. It's hard to see this playing out in a different way. Of course, there is the risk, as Emmanuel just pointed out, that we could get an aggravation of the bank lending crisis, and it could, possibly force us into a steeper recession. So that's definitely a tail risk that we have. But just looking at how things are playing out, this is where we stand right now.
So, Pooja, from an equity perspective, we're sort of flummoxed by this idea that particularly if you look at the financial crisis in 2008, that the equity market didn't make its final peak until about 2 months before the recession began. So I'm curious, what are the maybe 1 or 2 guideposts that you're looking at in terms of, higher frequency data that tell you that recession is closer or further away?
Yeah, I think one of the things that we have been focusing on is, of course, what's happening to the labor markets. So a lot of the resiliency that we're seeing in the U.S. economy, I think, can be tied